Good evening, ladies and gentlemen, and a very warm welcome to HDFC Mutual Fund presents Moneycontrol Mutual Fund Summit 2026, powered by Axis Mutual Fund. It's wonderful to see such a strong gathering of the ecosystem that has shaped India's mutual fund journey, including distributors, advisors, fund managers, fintech leaders, regulators, and industry partners. Your collective contribution brings us together this evening. Let me begin with where the industry really stands today. Over the last decade, we've witnessed extraordinary growth in participation. Mutual funds are now the backbone of household investing across the country. As of December 2025, India's mutual fund industry manages over 81 lakh crore rupees in assets, supported by more than 26 crore investor portfolios. Monthly SIP flows have crossed 31,000 crore rupees, in fact, signaling something deeper than market momentum. It signals habit formation. Mutual funds are no longer limited to metro cities or high net worth individuals. They are now embedded in India's household balance sheet. And that is the inflection point we stand at today, because scale brings responsibility. The question is no longer how fast we can grow, but how sustainably we can perform. How do we strengthen portfolios, navigate cycles, and move from participation to performance? That is the spirit of this year's theme: scaling participation, sustaining performance. What better place to host these conversations than Ahmedabad, a city built on enterprise, capital discipline, and long-term thinking, values that mirror the evolution of India's investment ecosystem. Before we begin, we thank our partners, presenting partner HDFC Mutual Fund, powered by partner Axis Mutual Fund, knowledge partner KFin Technologies, associate partner Reliance Industries Limited, and event partners Motilal Oswal Mutual Fund, Mirai Asset Mutual Fund, and ITI Mutual Fund for their continued support in strengthening India's investing ecosystem. Let's now move into our first discussion. Mutual funds have become the preferred savings and investment vehicle for millions of Indian households. But today, today's investor needs more than just products. They need solutions. Solutions that help them participate across equity, debt, commodities, global assets, and emerging asset classes, aligned to goals, risk appetite, and life stage as well. Now, this session explores how mutual funds can evolve into true portfolio construction platforms, simplifying diversification and making multi-asset investing accessible for every household. To lead this conversation, please welcome on stage N. Mahalakshmi from Moneycontrol, and joining her is an esteemed set of market veterans: Anand Radhakrishnan, MD and CEO, Sundaram AMC; Jitinder Pal, CEO, ITI AMC; Vaibhav Chugh, CEO of Abacus Mutual Fund; Saurabh Nanavati, MD and CEO, Invesco AMC. Please give them a warm round of applause.
Thank you so much. Is this audible? Thank you, Nandita. It's a pleasure to be hosting this event on behalf of everybody at Moneycontrol, the team at Moneycontrol. Thank you, all of you, for such an overwhelming response. I can see a lot of people standing at the back. It's great that we are actually hosting an event in Ahmedabad. This is a big moment for Moneycontrol. And Nandita has already set the backdrop in terms of where we are in the mutual fund industry right now. And this is a moment we have sort of, where I, as a journalist, has waited for, 20, 25 years, ever since I started my career in 2000. And finally, we are at a moment where a lot of Indians actually look at mutual funds not as a trading product, but as an investment product where, some part of your income actually goes into mutual funds for your future long-term goals, etc. While this is a wonderful thing, there are always all these wonderful things also come with some flip sides, some gaps that needs constant supervision, fixing, and so on. But But one of the thoughts I had, and we will steer this conversation around some of those thoughts, is with the kind of transparency we have in the mutual fund ecosystem today, with the kind of guardrails that a successive, the regulator, Sebi, has put over the years in terms of improving transparency, being very watchful of, adopting best practices with respect to everything related to mutual funds, and the menu of products that are now available, it feels like, once upon a time, in the 90s and early 2000s, every Indian household will, professional employed people will just look at, national savings certificates and fixed income products or center of plate savings. Today, it feels like whether it is debt or real estate, equity, of course, gold, silver, everything can be packaged as a mutual fund, and it will be a fantastic product just because the cost can be low, the transparency can be very high, and all of that. So I just want everybody to, take one moment to dream about where the mutual fund industry can be in the next 5 years. In terms of the, milieu of product offerings that can happen in this space beyond the conventional equity and debt, which has been there for years. But it is only in the last 2-3 years that we, gold has truly been shining. That's not because of the mutual fund industry, but because of the metal itself. But take a moment to just think about what does the next 5 year look like if you were to just say, we will reflect on this time. Where would we be in 5 years for the industry?
In terms of, I don't know about 5 years, but in terms of the asset class which is missing in the plate, in the mutual fund plate big time is real estate.
Yeah.
And it is not easy to make it as a product for investment because most of the real estate is consumed as for the personal use of people. So, but in the future, I can imagine a situation where, if not the residential one, the commercial real estates and the income yielding opportunity from commercial real estate can become a fairly good investable option. And that should be available to people at large, investors at large, so that commercial land is not, commercial real estate is not owned by only the wealthy and the rich, but is also owned by everyone. So unitization of commercial real estate is something I would imagine would happen.
Will you be launching?
I'm not sure.
Saurabh?
I think too much focus is on this AUM number, 81 lakh crores. I think that's an outcome. That's not the starting point. So if you want a direct answer from me, where would I like to see this industry in the next 5-10 years? The number of investors should increase from the 5 crore unique investors we have to anywhere between 15 to 20 crores. If we can achieve that, I think the AUM will be an outcome. It will be beyond your wildest dreams in that, in that period of time. And why I'm saying 15 to 20 crore retail investors, because you have countries across the world which have that kind of size and a much larger size even than that. The second is with per capita GDP growing dramatically or at a fast pace, this should happen logically in India. And the third element which I would, thanks for this theme actually, where you'll are now basically expanding this whole universe to multi-asset class. Yeah. Because for the last 5-7 years, mutual fund is being synonymous with equity, and I think that's wrong. It's synonymous with all asset classes. It's about being a platform for all asset classes, which gives you the convenience, which allows you to participate in small amounts, and which just makes it extremely tax efficient, even from an individual finance perspective. So I think this platform is on a very strong basis, a very strong fundamental starting point. And if we can reach that 15-20 crore retail investor mark, this industry will have grown manifold, but more importantly, that granularity of the business will actually de-risk the industry even more.
Oh, absolutely. Absolutely. No question about it. I'm glad you're saying this because it's not just 5-6 years. I mean, mutual funds have been about equity and markets in India itself has been only equities. I mean, in some sense, debt itself has been absent from the lexicon, except that bank deposits and, government schemes have dominated the savings scene. What do you think could be the innovations that could drive or are the kind of offerings that we have today enough and more? So we need to probably sort of not think so much about innovation, but just selling things the right way.
Sure. So first of all, if I can just touch base on what Saurav and Anand has already talked about. So, and you talked about next 5 years. So I will say next 5 years, my numbers would be like 200 lakh, but not less than 10 crore of investors. We are at 6.2, 6.3 somewhere, unique PAN investors.
So that's more than double. From 80 lakh, you're saying 200 lakh. That's
because
more than 12.5, 13, 14%.
And that is what should happen, because if your economy is growing 10% and the savings powers are there and you're going towards $6.5 trillion of economy in the next maybe 5 years plus or minus. So that is how the numbers are going to look like. The trajectory has to look like that. So along with that, comes the responsibility of managing this money in a way that meets the products are sold with the expectations where the expectations are not very high. And some of the things will have to be managed in that way. And there's one point I always like to add. The activation of distributions has to be larger than what we are today. Because that reach will have to grow along with, only then the investors may come on. Because otherwise, if the investors are coming directly, then maybe the product processes, transparencies, while we say they may not be aware. And the innovation you talked about, I would like to say, and I've been thanking Sebi for this for last 1.5 years. The SIF is an innovation which actually came in a very opportune time, and that is what will also help us grow. Because when we talk about fixed deposits, or though not exactly comparable, but there can be SIFs based on on where the expectation of returns are in that area. But the risk management is also in such a way where annuity returns or something can be put. But of course, so I think that innovation is just started to come, and we'll see that grow in the next 5 years also. So that will even add more AUM for us.
Right. So I want to come back because SIF is truly a remarkable product in terms of design. And you, of course, you've run long short funds in ITI earlier, not in the mutual fund avatar. So we can talk a little bit more about it. By Weber, from the standpoint of, if I could say, a challenger brand, like, as opposed to the large biggies who've been there for years, what do you see as the big opportunity? And in every industry, however big you are, the disruption comes from the periphery. For you, because you're sponsored by a person who has been a star fund manager, is that the big thing, or is there any plan to sort of do anything differently that captures the imagination of audiences?
Sure, thank you. Good afternoon, everyone. So Mahalakshmi ji, let me put it this way, that world has become very meritocratic, specifically in the last 5-10 years. There was a time when people used to rush towards, like you said, big brands, established brands, and past performances. But I think today, if we meet distributors, they really don't ask about the brand. They ask about processes. They ask about the risk management framework in mutual funds. They ask about what we have done in the past, track records of how we have managed money. So from that parlance, I would say that there's a level playing field even for a new AMC to come and operate, because everyone has become meritocratic, So is it a big challenge? Answer, I think it's a great opportunity for people like us and many other players who are coming. So that's one. Second, coming back to your question on the earlier part, which is 5 year and all, of course, putting number is difficult, but how I look at it is that mutual fund is a product from cradle to grave. एक दिन का पैसा हो या 100 दिन का पैसा हो या 100 साल का पैसा हो, one should look at mutual funds. And 1 day or 100 years, somehow people resonate mutual fund only with equity. So my dream would be that, if they have to invest in any asset class, gold ka soche, real estate ka soche, like Anand said, or even foreign equity, the only solution which should come to any investor mind should be a mutual fund. So we should create an ecosystem that people can believe mutual funds, not only for equity, but for any asset class they may wish to invest. And I think that's something which is very aspirational also, but it's a great opportunity. End of the day, like JP sir also said, we are only 5.2 crores. Now if we have to get 20 crores, sabka zarurat to ek nahi hoga. Somebody will ask for a substitute to FD, so which we are offering. Somebody would say, yaar, meko gold nahi kharidna hai, come to mutual fund, so we are offering ETF. But like real estate, koi bolta hai, we have to send our kids outside, have to invest keeping dollar in mind. So can I offer a product which can give product to their aspiration, through a fund which is investing in foreign equity. In fact, of course, on the AIF side, Sebi has helped us. We have private equity funds, but a lot of retail investors also ask, कि हाँ मुझे किसी company में listing से पहले जाना है. Today, only AIFs are there, but can we look at mutual funds offering those kind of funds? So there are a lot of things to be done. And like I said, maybe I'll repeat that from cradle to grave, we want to give every product for every requirement which may come to the minds of the investors.
True. You started off by saying something very important. You said, meritocracy is becoming more important because the distributors are becoming more discerning. I don't know how to respond to that, but the question is, in the context of mutual funds, how do you even define meritocracy? Because in mutual funds, meritocracy is reflected in the NAV, it is reflected in the performance. The bane is that investors look at short-term performance. Funds like to tell people to look at long-term performance, which itself can also change over a period of time. Somebody who was the star of last 10 years may not be even the star of the next 10 years. So is this, so what is some of your, what are your thoughts around how do you, the fact that investors chase performance is a reality, and how does the mutual fund industry really pivot this for investors to, in general, as an industry, pivot in a way that investors have good outcomes?
Yeah, if I have understood, actually the industry is meritocratic in the sense that people who have grown in size have grown purely by delivering
good returns,
good, consistent return across long periods of time. To that extent, you can clearly say that it is meritocratic. Now, how do investors and advisors and distributors decide what is a meritocratic fund or not? I think broadly they pivot to two variables. One is the fund house investment management process driven, or is the fund house investment manager driven? Both are valid pivots. If I like a fund manager and if I intuitively trust and I consider them as an expert, him or her as an expert, I would like to kind of entrust some part of my investments with them. That is the investment fund manager approach. I think the more enduring approach is the investment process oriented pivot, where investors who pivot to the fund houses which follow the right consistent philosophy, being on the right side of investing style all the time, be hygienic, on the right side of regulations, etc., and is supported by well-documented investment approach, risk frameworks, risk control policies, is what I think is eventually will determine long period meritocracy. Now, industry has now equally split between both.
Right.
At some point, as the size grows, I think fund houses will pivot towards the investment process oriented than the personality oriented. And I think that is the way I would like to define what is meritocratic.
sort of how do we make this change? And this is an important conversation because one of the things that really stood out for me in the last AMFI numbers that came out is that now gold funds have become more than 3 lakh crore in AUM. And while all of us have talked about asset allocation for the longest time, ever since I became a journalist, it happened only when prices started to move up and momentum sort of baited investors into finally taking that plunge. And it has all come in at a time central bank buying is actually, has come down. In 2025, total central bank buying of gold has actually, the growth has come down compared to 2024. So when you are seeing some kind of a moderation in the biggest actors in the world, your retail investors are piling on like there is no tomorrow. So obviously the message that you have to be driven by asset allocation and there is, goal-oriented portfolios, suitability, all of that, doesn't seem to somehow convince investors to, if I may use a slightly rude term, behave properly.
No, I'm not sure that that's the case, Mahalakshmi. I think, look, you can argue this last January numbers, 24,000 crore in gold ETFs and 24,000 crore in equity flows, and that's why it looks out of whack in a way. So 2-3 points to whatever you mentioned. Central banks have reduced, the growth rate has reduced, but they are yet buying gold.
Yeah.
So that trend is intact for the last 3-4 years, and it yet continues. They continue to buy gold. Retail investors maybe have got that fancy the last 2-3 months. But for all you know, gold may continue to move up because of global buying and global reallocation which is happening. So, in the US, for example, for 4 decades, fundamentally, distributors, investment advisors would always tell their clients, invest in equity and debt. And hypothetically, that proportion was 60% equity, 40% debt. For the first time in this last 1 year, we are all now saying, because of the US debt issues, which are real, which is there for all of us to see, and the way basically they are behaving, you need gold. So investment advisors are asking retail investors, the distributors are asking retail investors that allocate an X percentage to gold. And that percentage can be 5%, 10%, 2%. But there is an increasing allocation going to gold. And I think that's playing out here in India as well. So I would not look at this 24,000 crore gold ETF number versus 24,000 crore, say, of equity. In the larger scheme of things, if we are an 81 lakh crore industry and 3 lakh crore is in gold ETFs, I think it's a fair allocation. Nothing wrong in that. You've basically discovered an asset class late in the day. Debt, unfortunately, is not attractive at this point of time in the US as an asset class. Maybe it's not as attractive in India now at this point of time. Variety of reasons. Maybe the Indian government is borrowing more than what is desired. Yields are going up. You're not making returns. And in that kind of a situation, if you are getting into gold, 5 years down the line, I'm not sure, they may be laughing their way back, that we made a good call 5 years back investing in gold ETFs, this thing. So I'm not sure. I genuinely feel gold in this current global scenario is an asset class you need in your portfolio. And whoever does not have it will buy it. When he buys it, it's up to his choice and his portfolio. It may look lumpy in the data which comes in a month or so, but does not mean that it's wrong.
No. So maybe I should rephrase my question a bit. So the discussion is not whether the asset class will perform in the long period or not. The point I'm trying to ask is the fact that a pivot like this happens in itself is driven by momentum, not by messaging. How do we, therefore, as an industry, the messaging that we've been doing for 25 years in terms of how you need to save, invest, put asset allocation because that determines 99% of your return, selection is a smaller part, etc. That message somehow seems to not fall, firmly into the saver's mind. Therefore, I mean, maybe it will do better, maybe it will not, we don't know. In equities you say, if you buy at the peak, God save you. In gold, we are saying the momentum is intact, we don't know, So how do we ensure that the messaging is stronger? That's my question, because that's something the industry definitely needs to, deliberate on.
No, my simple submission is, at this point of time, unfortunately for the taxation reason, for the debt markets not developing as we would have desired the last 20, 30 years, it is not an exciting asset class. It's not grown. The numbers have not grown even for the industry. In that environment, you had equity as the main pivot. Gold is becoming a second pivot. And I don't see anything wrong in that.
Okay. Jatinder, any suggestions on how we can improve messaging? Is there a need for it?
So let me just put it a little differently what Saurav said. So everything I second whatever is said, but let me tell you, the messaging is out there. When we are talking to distributors are talking to investors, nobody says you put so much of money in a FOMO way. Rather, distributors' hand-holding is much better to the investor. Maybe some of the decisions are being taken by investors themselves. For a reason, maybe they find that your future may be holding good. So to say it is FOMO or is it future investing, sometimes we will on the cusp of saying, I would rather say, let it go with the general decision or wise decision of the investor oblique distributors. But at the same time, this has always happened, and this is not about gold. This has happened in any asset class wherever we have seen the returns coming, right? So I don't know what I'm going to say will be looked at. It can be criticized what I'm telling, but it has always happened, whether in whichever market you go, geographically or in asset class, that when the product asset class, the markets are done well, money do tend to flow in. And in expectation that it will do well. The only thing about India which I can say, we have a larger confidence that if economy is doing well, whichever level you come in with a time horizon, basic understanding. Ultimately, I think over a period of time, this risk will be taken care of. And when he was talking about number 3 lakh crores on 80 lakh crores, 2.5%, I think they underinvested in that case. The only thing is we have the largest holding in the world. Yeah. So to put it differently, if I remember numbers well, gold is now about $5 trillion and bank deposits are what, $3 trillion and plus. So how to say who is correct that way? So I think some of the behaviors can be questioned, but the industry is always there for asset allocation, managing overvaluations, markets that way. We are always doing that. But I would, as a business person, I would even welcome this kind of flows.
Okay. One question for you, Vaibhav. So one of the points that we were talking about is this, slightly short-term orientation, disproportionate focus on one-year returns and chasing performance, etc. Is there a way to pivot away from this? Just to suggest something very radical, is it possible for the industry to move away from even showing 3 month, 6 month, 1 year returns? You will only start showing returns for 3, 5 and 10 years. Especially at a time when, digital onboarding is becoming so widely used. And if the message has to go out very strongly that you need to look at it, it is not a closed-in product because you want to provide liquidity, but at the same time caution people that you need to only look at these returns. You think you would suggest we should move away from publishing for the industry to move away from something like that? I want everybody's view on this because this is a radical idea, but you should, everybody's thoughts.
See, we know there are cycles of markets and asset classes, right? There are short-term cycles, there are long-term cycles, and I think if we are showing 1 month, 3 month, 5 month performance, basically you are trying to tell that in a short cycle, how are the funds doing? In the long cycle, how the funds are doing? So saying that we will not show 3 months performance, will that resolve the problem? Answer is, I don't think so. Personally, I don't think so. I think it is as important to show 3 month performance as long term, because basically you're trying to tell that what is your upside capability, what is your downside protection. So that way it is good. See, I think industry has done a great job till now, because everyone has been advocating about portfolio, asset allocation, etc. And we have been saying, all the AMC colleagues have been saying this, that markets behave the way they behave. Asset classes also behave. The risk is actually in the portfolios rather than in the markets. So जैसे अभी gold की बात हुई है, अभी we don't know what percentage of gold is in anyone's portfolio. But हाँ, अगर 100 में से 80 रुपया gold में है, then there is a problem. It is not about one asset class. It is about me getting 80% into of my total portfolio there. So I think what we need to do, and we have been doing for 30-35 years, we have been advocating about portfolios, asset allocation. I think that has to become, that has to get even better in terms of reiteration. I'm saying, is it not happening? It is happening to a large extent, and it should happen. It should continue doing that. I think advisors will also have to play a very pivotal role, the MFDs, because if they sell a product, there's a problem. If they sell a portfolio, I think things will start getting better. Similarly from the AMC side. But good thing also is that this is what is happening for many years, that everyone has been working together. So I think we have come a long way, and we will continue doing well.
Sure. So quickly, everyone's take on this doing away with publishing short-term returns.
There is a famous saying in the market that you don't trade prices, you trade time horizons. People, for every price, there is a buyer and there is a seller. The reason someone is selling today doesn't make them a bad investor and someone else a good investor. So you need investors of all time horizons to participate in the market. That is philosophically I am answering. Second is data transparency. We are a very transparent industry. So much so that portfolios are disclosed on every month, and fixed income portfolios are disclosed fortnightly. So the industry has grown on transparency and performance transparency. It's different from many of the other industries where the full data disclosure about products are not available. So that is the strength we don't want to abdicate. We don't want to, surrender that. So like said earlier, I would strongly go for even weekly return also if you want to give. If people are happy looking at it, please give.
No quarrel about that, but the Web of you, both of you have made this point that even short-term returns need to be published because it tells you about, what is the risk in the short term. But the fact that you are giving it at a point in time has endpoint bias. So if you do 1 month return rolling over whatever time period, your numbers may look very different, and it might be a lot more intelligible, but everybody will crib that there is so much data deluge and what is the point, etc. So,
fair point. I agree, but I think investors will pick the data points that suit the time horizon.
Yeah.
That option should be with the investors. That's the limited point. If I am a 6-month investor, let's say in banking and financial services, I should be allowed to invest in that.
Invest in it.
That's
Even for the short.
Yeah.
Fair enough.
So
Saurabh?
in my individual capacity, I will always tell people to look at 5 and 10-year data. But come on, you can't set these rules only for mutual funds all the time. If you are holding an IPL auction, who will get the highest price? Is it somebody who has just performed well recently, or somebody who's got a past track record and he's not performed well recently? Today, Dhurandhar is a hit movie. The actor is appreciated for that. If it would have been a flop movie, he's gone, right? He'll have to work hard. So there's nothing wrong. If a batsman scores 0 and Kohli scores 100, in the next match, who will you back? You're going to back Kohli, period. It will take, a very big call for somebody to say, back this guy who scored 0 because he will bounce back. So let's not overdo this. I think the industry is basically showing performance across all time periods. We are educating people about rolling returns. We're educating people about SIP that come in for 3 years, 5 years. You look at the SIP data, these are now, all the SIPs are forever, right? 10-year SIPs, 20-year SIPs. So it's paying out. So let's not overdo this position of 1 year. I don't think logically, by behavior, in every facet of life, you will look at recent performance in every aspect. That drives your immediate decision making. But I think the distributor community is doing a great job in basically telling them to look beyond that also and looking at longer periods of time.
You've actually pivoted this conversation, but we don't have time to argue over this, because the case cannot be that because this is human behavior and psychology, we can't do things differently, because the endeavor of the industry will always have to be that you need behavior that is more long term, but that will be a different conversation. But gentlemen, thank you so much. Absolutely wonderful discussion to kick off this event today. Thank you so much.
Thank you.
Thank you, Mr. Radhakrishnan, Mr. Pal, Mr. Chug, and Mr. Nanavati, and Mahalakshmi as well, for sharing such thoughtful insights and practical perspectives. Your clarity of vision helps strengthen the foundation of India's growing mutual fund ecosystem. Now, before we proceed ahead, let's take a moment to watch how HDFC Mutual Fund celebrates the power of discipline, dedication, and new beginnings. Values that mirror the journey of long-term wealth creation.
ये जिंदगी किस्तों से बनती है, जैसे ये पहली किस्त हमारे जज्बात की। ये किस्त संयम की, प्रकृति के नियम की। ये किस्त एक छोटे से सपने की शुरुआत की। ये किस्त नन्हे कदमों को बढ़ावा देने की।
गिर के संभलते जाना तो, उड़ने से ना घबराना तो।
ये किस्त श्रम की, परिश्रम की, गिर गिर के उठने की।
तू राहों के सबक को सीढ़ी बना के चल, छोटी छोटी परवाज़ों से संवरता है कल।
और ये किस्त दुआ की, आशीर्वाद की।
तू राहों के सबक को सीढ़ी बना के चल, छोटी छोटी परवाज़ों से संवरता है कल। गिर के संभलते जाना तू, उड़ने से ना घबराना।
ये किस्तें और कुछ नहीं, बस इन्वेस्टमेंट ही तो हैं, जो हम सब करते हैं अपनों के कल को बेहतर बनाने के लिए। तो देखा जाए तो हम सब इन्वेस्टर्स ही तो हैं। जब जिंदगी जीने का तरीका ही SIP है, तो जिंदगी के लिए SIP क्यों ना हो? जिंदगी के लिए SIP।
HDFC म्यूचुअल फंड का निवेशक शिक्षा और जागरूकता अभियान। अपनों के लिए पहला कदम लें। म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
All right, let's move on then to the next session for the evening. As the participation scales and the markets deepen, the role of regulation becomes even more critical in ensuring trust, transparency, and long-term stability. Our next speaker represents the institutional backbone of India's capital markets. He has been closely involved in strengthening governance standards, enhancing investor protection frameworks, and guiding the evolution of India's securities ecosystem during a period of unprecedented growth and complexity. Please join me in welcoming Amarjeet Singh, whole-time director, a member, Sebi, to share his perspective on the regulatory priorities shaping the next phase of India's mutual fund journey. Mr. Singh.
Thank you. Thank you very much for that very kind introduction. Very good afternoon to all of you. It's a pleasure to be here, and I must compliment Moneycontrol for doing this in Ahmedabad. If we have to actualize the vision of Har Mutual Fund, then I think we have to go beyond the big cities, and this is a very good initiative, and I believe Har is not just big cities, and you have to go beyond the big cities and go to the smaller towns. The theme of the event, from savings to solutions, powering Har Mutual Fund with purpose and protection, and that's what Mahalakshmi sent to me. I believe it captures a very profound shift which is underway in India's financial landscape. For decades, as we all know, India has been a nation of savers. We've always had a high savings rate. Today, we are steadily becoming a nation of investors, which is a very significant shift. The composition of household financial savings has changed significantly over the past decade. As per the latest economic survey, the share of equity and mutual funds in annual household financial savings increased from around 2%, just 2% in financial year 2011-12 to over 15% in financial year 25. That speaks a lot. In contrast, the share of deposits declined from 58% in financial year 11-12 to around 35% in financial year 25. So something is happening here. These numbers tell you a story. The shift has coincided with a steady rise in SIP contributions. Monthly SIPs flows today are around 31,000 crore in the January numbers, increase in demat accounts, increasing retail participation across geographies. And mutual funds are at the center of this transformation. They serve as a powerful vehicle for democratizing wealth creation and contribute to India's growth story. So my remarks are, broadly going to be in three parts. First, I'll share some reflections on the growth of the mutual fund industry, and a lot of it has already been talked about, and we need to celebrate that. But while talking about the growth, let me also share some numbers from a recent investor survey which Sebi did with the help of MIIs. We covered 90,000 households across the country, and the survey is available on our website. I'll pick some numbers from there as well. I'll also like to outline some recent initiatives undertaken by Sebi to support and strengthen this growth. And finally, I'll conclude with some thoughts on ethics and culture, if I may. We have built enough legal guardrails over time, but are they enough? We can keep doing more and more rule making, but I guess ethical guardrails have to supplement the legal guardrails. There is no substitute for ethical guardrails. I like to talk about that a little bit towards the end of my address. So let's look at the growth of mutual funds. As we all know, the Indian mutual fund industry dates back over 60 years, but it is only during the last decade that its growth has really stood out and captured greater attention. Over the past 10 years, the industry AUM has, you can't do without talking about the AUM. So the AUM has grown more than sixfold to over INR 81 trillion as on January 31, 2026. And to my mind, the number of 100 trillion doesn't look very far at the pace which we are growing today. The number of unique mutual fund investors has grown to about 6 crores, what used to be 1 crore a decade ago. DIIs have the domestic institutional investors led by mutual funds have recently surpassed the ownership share of FPIs in the NSE listed company. Again, a very landmark achievement in some sense. While all this is undoubtedly good news, as more and more money flows into mutual funds, to my mind, the need for continuous flow of quality investment opportunities gains more importance. And we are lucky to have a good IPO pipeline. Market in various segments has been showing signs of growth. But I hope, this momentum continues, because as more and more money comes in, you need investable opportunities, and that is very important. Despite this remarkable growth, the journey to Har Ghar Mutual Fund is far from complete. Over 52% of the industry AUM still comes from the top 5 cities alone. That is Mumbai, Delhi, Bengaluru, Pune and Kolkata. And that is why, events of this kind, the public discourse or the discourse with investors has to transcend the bigger cities. In this context, a recent Sebi investor survey provides some interesting insights. While 53% of households are aware of mutual funds or ETFs, only about 7% actively invest. In rural India, awareness falls to 45%. 45% is also a good number to my mind, and participation falls to around 4%. And the participation is closely linked with education levels, income brackets, and occupational profiles, so which is quite predictable from a common sense point of view. We therefore need to do more in terms of enhancing access and participation. And it has to be an informed participation, and we have to work together to see that the increasing participation by investors is done with all the information they need for investing. The idea of wealth creation has to percolate down to lower income segments. The market ecosystem should not only benefit sophisticated investors, its benefits should also extend to lower income segments. We all have to come together to make it happen. This is particularly important in the context of income inequalities in our country, in our society. Let me talk about some of the recent initiatives of Sebi. We definitely, can play a key role in expanding access to financial products. And as participation widens, our responsibility to ensure strong investor protection also becomes even more critical, equally critical. Let me share a few recent measures taken by Sebi. So first I'll talk about expanding reach and then also expanding the investment spectrum. So we recognize that expanding mutual fund penetration beyond the top cities involves higher costs and longer gestation periods. Smaller towns and semi-urban areas often require more conversations and deeper trust building. Keeping this structural reality in mind, Sebi has recently re-enabled, it was already there and we enabled it again, an additional incentive framework for investments mobilized from B30 locations. This framework becomes effective from March 1, 2026. On similar lines, we've introduced an additional incentive for mutual fund distributors to encourage greater onboarding of women investors who have been historically underrepresented in capital markets. Another important initiative, and which connects to the point I was trying to make, that we have to make sure that the industry helps all income segments, particularly the lower income segments. So Choti SIP of rupees 250 to enable participation from lower income segments and advance a larger national objective of enhancing financial inclusion. And again, all of us have to work together to make it happen. These measures have the potential, we can do more, but these recent steps or towards realizing the dream of Har Ghar Mein Mutual Fund. I mean, that's the theme that you've taken. Expanding the investment spectrum, and already some discussion happened in the previous panel. While widening access is important, the range of investment options must also evolve. We have to have, as the markets mature, as more money comes into play, you need to have more innovation, a responsible innovation, innovation with investor protection. So Sebi survey shows that investors in mutual funds seek long-term growth and goal-driven strategies. Mutual funds are well positioned to deliver this with a wide range of products. Let me mention two recent initiatives. First is SIF, which bridges the gap between mutual funds and portfolio management services. And it's good to see, so far the traction looks good. As on December 31, 2025, the total AUM under the investment strategies offered by SIFs stands at INR almost 5,000 crore. It is exact number is 4892 crores. Similarly, the recent regulatory change enabling greater participation of mutual funds in REITs, real estate investment trusts. So that's another vehicle, REITs, InvITs, municipal bonds, corporate bonds that we are focusing on for the purpose of, enhancing infrastructure financing from the market side. So we've recently reclassified REITs as equity-related instruments, which will further expand investment opportunities and also support diversified portfolio construction. So, as I said, one, in terms of expanding reach, we've given certain incentives and also introduced these new products. Going back to the point I was trying to make earlier, and let me first give you another data point from the investor survey. Nearly 80% of households prioritize capital preservations. That is that, nobody wants to lose money, which one is putting in. Returns may be low or high, but one is very particular about the principal amount. Therefore, it becomes important that as more households enter market, this expansion must be anchored in informed participation with realistic expectations around returns, volatility, and risks. Clear and transparent communication is essential to sustaining trust. Especially, in today's times when the volatility and uncertainty is very high, investors must have all the right information before they decide to invest. Let me move to another dimension, that is of protection. Sebi continues to be focused on retail protection and market stability. We believe in promoting competition, we believe in innovation, but investor interest definitely remains paramount in doing all of this. We've recently undertaken, some of you would know this, it was a very massive exercise of reviewing and redrafting our mutual fund regulations. Now we have, what is in operation today is Mutual Fund Regulations 2026. So basically we've revisited and redone the entire piece. The objective was to enhance clarity, improve structural coherence, and simplify compliance. The norms pertaining to total expense ratio have also been rationalized and simplified towards greater transparency and clarity for investors. Surveillance and enforcements are again very key components of investor protection. And in today's market, effective surveillance requires technological capabilities because you have thousands and thousands of data points floating around us as the markets grow, and it is humanly not possible to capture every data point, so you need the help of technology. Let me talk about surveillance at three levels. One, at the Sebi level. second at the AMCs level, and third at the level of AMFI. At the Sebi level, we have significantly ramped up our supervision and monitoring with the use of technology in recent years. We have a range of online tools which effectively supplement on-site inspections. Alert-based off-site inspections enable comprehensive data-driven supervision of AMCs. So, a lot of data is scanned in our office, and which also throws alerts, and based on those alerts we are able to pick up with the AMC or any other player in the market if there is anything which is amiss and which needs more clarity, more understanding. So that is really helping us a lot. We've recently launched 2 additional tools, and both are AI-driven supervisory tools. One is called RAIDAR, R-A-I-D-A-R, and this is Regulatory AI-Driven Advertisement Reviewer. And another is Project Sudarshan. This is called Surveillance of Unauthorized Digital Activity via Real-Time Scanner for Anti-Fraud. These tools scan social media and advertisements to detect potential fraud and mis-selling. So see, mis-selling can happen broadly in 2 ways. It could happen in a bilateral conversation where a seller of the product is talking to the buyer of the product, or it could happen from many to one, or rather one to many, not many to one. So you could have an AMC advertisement which is targeted at many buyers, and this, I'm just saying hypothetically, this advertisement could be misleading, could be against the code of conduct that we have. So these tools will help us scan that both in the advertisement space and the social media space and throw alerts. And these are all being done with the help of AI. Now let me talk about the surveillance at the AMC level, and I believe this is probably a more effective, can be a more effective piece here. The first line of defense, however, continues to be with AMCs, because that's where the action happens. Sebi has prescribed a structured institutional mechanism to be implemented by AMCs, which can proactively identify and deter instances of potential market abuse, including front-running and fraudulent transactions in securities. I would like to remind and emphasize the need for effective implementation of this mechanism by AMCs. It's been a while since we put this out. Now, talking about AMFI, the industry must also strengthen mechanisms to prevent mis-selling and unethical practices. AMFI's quarterly reports highlight instances such as unauthorized switches, forgery, fraud. In fact, even our system, sometimes throws some very interesting instances where, let's say, a retirement product was sold to a non-individual, sold to a corporate entity or to a trust, or a retirement product, it may sound absurd, sold to a minor, or a very risky small cap scheme sold to a retiree. So we do come across such instances thrown by our system, and then we pick it up from there. So AMFI is doing a very good job of compiling the instances of mis-selling, unauthorized switches, forgery and fraud. But let me tell you something interesting here. What is more concerning are the cases where investors may not even realize that a product has been missold. Or he may realize 5 years down the line, because it's a long-term product, he just buys it, he takes a person on the face value, doesn't really care to go into too much of detail. But actually he's been missold and he may not even realize. And there is no way of detecting these instances. 5 years down the line, he may not even complain. So it is this less visible dimension that we need to guard against. See, we should take pride in where we are in terms of the growth of our industry, and also the kind of checks and balances, kind of structures, kind of regulations which are in place. So we have to think of the next level, how we can make it better. So this is where this point lies. So can we handle the area which is not, presumably cannot be caught by data, right? It goes beyond data capture. Let me now move to ethics and culture. And Navneet is there in the audience, and Mahalakshmi also. We've been talking about this, how together we can do more in this space. First, the context. We recognize that the investment landscape is rapidly changing, competition is fierce, pressure to innovate, pressure to grow AUM and to deliver superior returns has become more intense. The growth of online platforms and the increasing influence of digital channels and social media is shaping how investors access information and make decisions. In such an environment, it can be tempting to chase growth at any cost. Rules and regulations therefore play a vital role in providing the necessary guardrails that protect investors and ensure discipline. Yet, rules can only take us up to a point. The legal guardrails, as I said in the beginning, have to be supplemented by ethical guardrails. What truly matters is outcomes, investor outcomes and market outcomes. That is why it is not enough to focus only on scaling up. We must scale responsibly and in the right way. A strong culture of ethical behavior amongst all players in the mutual fund ecosystem is the best safeguard against the lure of quick wins. It is the key to ensuring that investor interests are always placed above short-term gains and that long-term value creation remains our guiding principle. I believe self-driven ethical conduct will be critical for orderly and responsible growth of the industry. So I have something specific to mention here, what we can do together with the industry. I commend AMFI, and I know, Navneet, you were instrumental in setting up that ethics committee at AMFI level, which is a very timely initiative. So AMFI has a committee which is called Ethics Committee, and that's a very timely initiative. To further strengthen its impact, the mutual fund industry could explore scaling and institutionalizing this effort. So idea is we have a committee which is great, but can we take it to the next level? And how do we take it to the next level? So we can target key ecosystem participants such as distributors and AMC professionals. So targeting them, a lot can be explored, such as development of online ethics capacity building modules, creating practical scenario-based case studies to address real-world ethical dilemmas faced by industry participants, development of AI tools to detect mis-selling, and somewhere where the media also can play a role is that we bring ethics to the forefront. We bring debate, discussion on ethics front and center. Otherwise, it is just something which is, I mean, we all know we have a code of conduct, but who reads it? Or maybe we read it, but do we remember it all the time? The industry could collaborate with NISM towards these objectives. An effective framework could be jointly designed in close consultation with industry stakeholders. It could potentially take the form of a dedicated center or institute of ethics or school of ethics, whatever you want to call it, for fund management industry, operating under the aegis of NISM to deliver structured, high-quality training and certification in ethical practices. It could do a lot of things. It could do capacity building. It could do more research. It could develop case studies. It could, develop AI tools and so on. So I think there's a lot of scope for exploring all of this. Let me now conclude. The mutual fund industry is no longer serving a narrow urban segment. Mutual funds are not just financial products, they are partnerships in India's rise. The industry is confidently marching towards INR 100 lakh crore mark. It is increasingly reaching first-time investors, small-ticket SIP participants, and households transitioning from fixed deposits to market-linked instruments. As this base broadens, all stakeholders, AMCs, distributors, industry bodies, and regulators, all of us share a collective responsibility to ensure that this transition is smooth, stable, transparent, and sustainable. If we align innovation with integrity, expansion with ethics, and growth with strong safeguards, the vision of Har Ghar Mutual Fund can move beyond aspiration and become a defining feature of India's financial landscape. Thank you very much.
Thank you, Mr. Singh, for those insightful and thought-provoking remarks. Moving on, as India's financial markets deepen and participation widens, the real differentiator for institutions is not just scale or performance, but values. The principles that guide decision-making, the governance frameworks that protect investors, and the culture that sustains trust across market cycles. I would request N. Mahalakshmi to come back on stage to steer a deeper exchange on ethics, institution building, and long-term credibility in financial services. And requesting Mr. Singh to join us back on stage, and joining them is a leader who has navigated multiple market cycles while building one of India's most trusted asset management institutions, Navneet Munot, MD and CEO, HDFC AMC.
Thank you, Nandita. It's absolutely delightful to have both of you on the stage here. And thank you, Mr. Singh. Thank you, Navneet, for making it to this event in Ahmedabad. And thank you, sir, because the day we started talking about this thing, you gave us a lot of encouragement to going to, smaller cities. This is, of course, by no means a smaller city, but look beyond Delhi, Bombay, into other cities. And this is our first initiative, and doubly glad to have you here. And this topic on the value of values in financial services, when I was in college, we used to always debate, is finance the villain or marketing is the villain? Because mostly, ad industry is spoken about as not speaking the truth. And then there was a time in India where mis-selling in lots of financial products hogged the limelight. And I don't think we can say that about mutual funds, because it's come a long way. And nevertheless, because this is about savings, people rely on, on their savings and investment for such important goals in life. It's even more important. Mr. Singh, from a regulatory perspective, of course, the mutual fund industry has come a long way in terms of disclosure, transparency, incentive structures that align more in the interest of investors, etc. What do you think should be the journey towards? Where do you still see gaps that the industry needs to plug? Or where would you like to see greater efforts in terms of taking this conversation forward?
So I thought probably you're going to ask him more. I already spoke enough, but
so the questions are the same for both. You have to talk from your expectations from a regulatory perspective, and he's going to talk about, from an industry perspective, where they are and where they're going.
So, I'll probably repeat what I said. We've come a long way. In fact, when I started my career in Sebi, which was 30 plus years ago, we had this one vision was not very clearly defined, but we knew we have to, bring about equity culture in the country. And one huge component was that mutual funds will be the vehicle for retail participation, and more. And we used to look at developed jurisdictions like US, etc., where there is a lot of depth in these markets. So it's good to see that's happening eventually. So we've come a long way, which we need to celebrate. But at the same time, we have to be, and also we are growing. It's not that, despite all sorts of uncertainties or volatilities today in the geopolitical environment that we are in, we are seeing more flows coming in. So I think there we need to be more responsible in whatever role we are in. We need to consolidate the growth that we have seen. We should make sure that there is no big mishap, which puts the investors away.
Right.
So see, the investors, the first-time investors, are reposing a lot of faith and trust in the Indian companies and in the vehicles. Vehicle is mutual fund, PMS, and so on, through which they are investing in. So the confidence at both levels, so therefore the emphasis on governance, transparency, better supervision, those are the things which come to my mind, and we should just maintain this good spot. Yeah. So I'll just pause with that.
Sure. Navneet, your take on, first of all, this is definitely a moment to celebrate. Are there any places where you today think that there are vulnerabilities or weaknesses which could in some ways undo the kind of trust that today investors repose in the fund industry, and which is very evident that, at every drawdown, not that we have had very sharp drawdowns, but every drawdown, everyone was anticipating that the next SIP flow number kya aane wala hai, are there going to be redemptions, etc. It has not happened to the extent that one feared. So, which says that, something's working very well. But do you worry about something, that any vulnerabilities in the system that could, take some part of all the good work and trust that has been built carefully over the years?
Sure. So first of all, it's such an honor and privilege to share a stage with him. Every time I interact with him in any capacity or I listen to him, ethics, values, culture is like a common thread you will always hear in whichever topic he is speaking. But you will see some of those words and his take on all of that. Also a privilege for us to be associated with Moneycontrol in curating this thought leadership event across the country. You said thank you for coming to Ahmedabad, but I'm a Gandhi follower, and this is like a holy place, and this is the land of Gandhi and Patel and Srimad Rajchandra. I mean, this is such a holy and pious land. So always a pleasure to be here. And talking about, like Gandhi said, that the best way to find yourself is to lose in the service of others. The best way to find yourself is to lose in the service of others. And this is what our industry truly stands for, that here there's such an opportunity that this country will grow. All my predecessors, talked about it. You will hear from some of the outstanding CIOs who are here about the growth potential this country has. And I think it's such an opportunity for our industry to ensure that fruits of growth reach each and every household. There's such a noble objective that we have, and if we can spread that prosperity to each and every household, I think that is such a big opportunity for all of us. You talked about the vulnerabilities. On one side, we take deep pride. My colleagues from MF board are here. We take deep pride that unlike many other parts of the world where we follow industry body, here in India we take deep pride that we work very closely with the regulator. We kind of like co-create, we collaborate in a highly cohesive manner with the end objective, which are very similar to the preamble of Sebi, where it's always about investor protection, market regulation, and market growth. And they are not competing goals. I think they have to be interlinked. They have to be integrated. And this is what our industry really stands for. Trust compounds fast. The trust compounds faster than wealth, but can be destroyed in 5 minutes. So I think we always have to be cognizant of that faith that at no point in time we do anything which impacts the trust of the end investor. Then all these goals will look like dreams, will look like which will never be able to achieve. I think it's very important that every single thing that we do day in and day out must be to enhance the trust. And for that, I think both the end as well as the means have to be right, and that's where the role of the values. So it's such a privilege to share a stage with him and have this conversation on the importance of values, ethics, culture.
True that, but where are the gaps?
I think,
Do you see any gaps?
so when you are growing fast, at times there would be like certain incentives, or there would be maybe I think you get lured by maybe a short term. You had a good discussion about the short term versus the long term. But I always say that growth and governance are not like competing goals. They have to work together. You can build a business faster. You can grow your profits faster or AUM faster. But if it is not combined with deep governance and right set of value system, then it won't be sustainable. So for sustainable growth, it's very important. I think like in an industry where there are 50, 60 plus players, I think very soon, we just crossed 50 last year, 60 plus players, there are many more entering. And my request to everybody would be keep thinking that one step or misstep by one player can impact the entire industry. I think the famous fable that we were told in childhood, that there was this king who asked people to bring in 1 glass of milk to put that in the pond. Everybody thought that I'll carry 1 glass of water because in such a large pond nobody will come to know. But next day there was only water. So I mean, each and everyone has to think that whatever I do is like relevant for the industry and making a difference.
True. So the same point I want to actually pose to the two of you, that I think one of the deepest concern one can have, there can be several, but this is truly about investor behavior, because Morningstar has also done the study that the fund returns, there is always a difference between fund return and investor return because of poor market timing. And we keep sort of talking about it, but at one level, like Saurabh was saying, that this is what human psychology is. You can't fight it no matter what you do. But is there merit, sir, in the argument that, as an investment vehicle, if the equity product is for the long term, then all communication should be towards that. So therefore, instead of more disclosures, banning disclosures of returns under 3 years, because that's the minimum period that you need to go to, or any thoughts that can be radical to be able to help investors think more long term.
So that's a very interesting thought, and I was listening to the question that you raised to the previous panel. So see, it is fraught with its own risks, and I'll tell you what I mean by that. If you today, we are living in an age where information travels very fast, and there's an expectation on both the speed and the frequency to only increase. If you don't disclose anything for 3 years, as a regulator, I would say there is a potential risk of creating huge information asymmetries in the market. And people would be guessing, the insider information would be at premium. It will add more headaches to us. So I would rather say you disclose as much as you can. I'm not saying we should go to another extreme, but the present disclosure system is good, in terms of labeling of the product, the riskometer, right, and so on. So there are various disclosure mechanisms in place. Just make sure that, whatever is disclosed properly with the proper person. I take your point, right, that there should not be a misleading disclosure, even within the existing disclosure framework. So those are nuances which we have to be careful about, but perhaps I would hesitate to go to the extent of saying no disclosures for the next, or just long-term disclosures and no short-term disclosures. Let investor, see, the way to deal with it is, let's make investor more intelligent. In the sense, investor is already intelligent. Right. Let's give him more information. Let him decide. That is the basic philosophy. It's a disclosure-based regime.
Right. Navneet, one of the things I wanted to talk to you about is, we've also spoken about it earlier, because the number of AMCs that are getting listed on the bourses is increasing, and this year we'll have the largest also getting listed, which is SBI Mutual Fund. Is there greater level of, when it comes to, you as a public company, there is, you're a lot more cognizant of top line growth, increasing the bottom line growth. That and, investor interest, are they in conflict? Are they, how do you look at this whole issue of being a listed company? Does it add more pressure in terms of, in terms of how you would do businesses, fund launches, and so on and so forth? Is there any conflict with the investor interest?
There cannot be a conflict between the unit holder and the shareholder. What shareholder wants is sustainable, durable, long-term growth, right? Long-term value creation. That can only come, if you have client centricity, if you think about your business in a sustainable manner, if you think about business with a long-term orientation. And there's no way, that's true for every business. So we are an investor first, right? So we invest lakhs of crores in many companies. Would we choose one management which is looking at next quarter or next year versus somebody else who's thinking of building business sustainably, building business in the longer run? Our chairman, Mr. Parekh, always says that client centricity is the only competitive advantage you can build in our business. Client centricity is the only competitive moat that you can build in our business, and that has to be at the center. And if your clients are happy, if they are investing more with you, that's how you will create more value for the shareholders. So there is no way there can be a conflict.
Sure. From a regulatory perspective, sir, is there a different lens that you would look at, like a listed company versus a unlisted? Is that something that you even care about?
So I tend to agree with what Navneet said. In fact, you have one more stakeholder, in the sense that public shareholder who's going to scrutinize whatever you do. And I think I'll just add to what he said, if we are able to make public shareholder also see that the long-term growth of the company lies in serving the client, serving the customer in a sustainable manner, that would be a win-win for both unit holders and the shareholders. So I really don't see a great conflict there.
Fair enough. Navneet, one question
a lot
around...
of our distributor friends who are sitting here were very unhappy when we stopped taking even SIPs in our defense fund. And maybe a few more 1,000 crores would have come. The point was that the fund manager's view was that, no, I think it's getting a little overhyped in terms of valuations and investors' expectation. There is a mismatch between what investors are expecting and what the prices are reflecting. So again, going back to that point, is there a conflict? Not really. I think not having those few hundred or few thousand crores actually will lead to a better value creation in the long run, because you want to keep your investors happy.
And I'm tempted to add here, so this is the kind of behavior we as a regulator like. See, this is a free market. If you are disciplining yourself in terms of, you're saying, okay, I'll not accept any more investments in this scheme, or I'll accept only X within per month in this scheme. So these are some, guardrails which you are putting yourself without us telling them that. And we won't want to tell this because it's a free market. So.
Right. So one of the things we also discussed in the first panel is about this new categories, and SIF has been a huge innovation, and it's something that a lot of AMCs are very bullish about, that as a category it can be big. At the same time, the regulatory environment in India has not been so far very supportive of short selling. What is your vision in terms of, where do you think this product can really go? How big can this category become?
So we'll have to wait and see. It's a little early to sort of premature to, but the traction is good. And let me also explain where we were coming from. Maybe it's not very well known. See, in today's world where social media, there are a lot of finfluencer, everybody is guiding without necessarily having expertise or registration with the regulator. So there we found that, and most of you would know this, people are offering fantastic returns, and a lot of innocent investors get caught in those schemes. So when we were designing this product, so that was our starting point. There is people want to take more risk, and they are going to unregistered players, going for unknown products. So why not create a product which is somewhere between the mutual fund and the PMS, and which offers you the potential of higher return with certain risks that you take. So it's a kind of a risk-return trade-off there. So that was the thinking behind introducing this product, so that people can shift from unregulated space to a more regulated space. And we'll have to wait and see how it plays out. It will depend on the success of the product. So let's give it some time.
Right, fair enough. Navneet, one issue that sort of came up lately is this issue of a lot of, precious metal ETFs, for example, gold ETFs, silver ETFs, etc., trading at a significant premium to the underlying, and then there were discounts also. Now, one of the reasons we sort of, moved away, the industry itself moved away from closed-end products is they used to trade at a significant discount, and it wouldn't get bridged and so on. And Sebi itself, 2 years ago, when there was a market frenzy in small caps, they flagged saying that this segment, there is some kind of overvaluation in the segment. Here you have a product that is so much volatility in the ETFs, and on day one, on certain days, a fund investor is ending up investing in a fund where he is 10% down on day one. Now, from an industry standpoint, because it's significant, like 10% means you're like eating into 5 years or 10 years of fee, to just put it in perspective. So as an industry, does this, do you feel concerned about it? Is there a way to deal with it? Because this frenzy around ETFs, around precious metals is not going away. 1 month it goes up, then, it will continue 2 months. If it goes down, then it will die down. But there is interest. As a product structure, does it concern you? Can something be done about it from the industry standpoint? Then I'll come to Sir also.
I think it's part of the, so we all talk about the financialization of savings, but I think what we are seeing increased interest in gold and silver ETF, or maybe you had discussion on REITs and InvITs, are also part of the financialization of assets, which is again a large structural trend like financialization of savings. And it's good that instead of investing in the physical form, I think ETF is a far better way to own. You had the discussion in the previous panel that people will have certain allocation, but one needs to keep in mind if the asset class is so volatile, which can move up or down at 10% or so in a day's time, then how much allocation you want to have to that particular asset class and how you want to invest. Do you want to have a structural allocation and maybe a little bit tactical here and there, but otherwise I think you will be prone to that volatility. I remember a few years back, a lot of us in the industry went around and talked about the demand-supply dynamics in silver, the industrial uses of silver and all, but there were like hardly any interest among the investors. And today when I walk around and I tell people, then don't over-allocate to silver, and the person tells me that, sir, do you know how much it gets used in solar panels and EV and aircrafts? I said, that's what we mentioned in our presentation a few years back. So one should not really chase some of these fads and should kind of like consult a good distribution partner to do the right kind of allocation in the right manner.
Sure. Your thoughts, sir?
I really don't have much to add. ETF is definitely a good product, no doubt about it. But given what is going on, and I don't want to talk much about that, you might be aware we've come out with a consultation paper on the price bands on commodity derivatives. So let's see where we land on that. But let me just hold back on this.
Sure, thank you. That's all the time we have, so thank you so much.
I remember Vanguard founder once, like several years back, said that index fund is a far, even if you are investing in passives, then index fund is a far better way to do that. And they were the ones who were actually resisting the way people would look at the ETFs. And if you watch the US markets today, the kind of products that are getting launched, and then they have like options on ETFs, then they have collar that you can write or buy, and then you have like CLOs getting structured on the ETF. So it's a different level of financialization which may not be good for the society. I've always used this line, we might have discussed Mahalakshmi at earlier forums, that finance must be for the ultimate good of society. Everything that we do as an industry association, as an individual participant in the market, whichever area of the market you are in, you always need to keep in mind everything that you are doing is it good for the society? If it doesn't tick that box, then a lot of it is actually not required. It may just be like increasing profit pool for someone, which may not be very sustainable.
Just to add to what Navneet said in the end, so this public interest element which is involved in this industry is huge. And while of course you are there to make money and nobody is disputing that, but guardrails become very important, both just to ensure that the public interest, the public confidence, the trust that we built over so many years does not disappear very quickly. So the two kinds of guardrails, legal guardrails and ethical guardrails. Legal, we are doing a lot. Ethical has to come from all of us together. Yeah. Thank you.
One of the things that are happening in global markets, and this is across all markets, is that you have more money going into the passives, which create a momentum bias. Then you have a large part of money in trading, which is coming from the algo, high frequency trading, hedge funds, which again is kind of like driven by the momentum. And then you have large number of Robinhood investors who are again chasing momentum. And together all of this has increased disproportionately to the underlying real cash market volumes. Is it good for the society in the long run? I think there are question marks, and I think somebody has written like gamblification or the gamification of markets in the long run cannot be good.
Correct, true that. That's all we have time for, but thank you so much, Mr. Singh. Thank you, Navneet, for joining us for this.
Thank you, Mr. Singh and Mr. Manoj, for your valuable insights on leadership, values, and institution building as the industry scales with responsibility. I would request N. Mahalakshmi to now stay back for the next session as well. Now, with equity valuations elevated, interest rate trajectories evolving, and global risks still present, asset allocation choices have rarely been more complex. Should investors lean into equities, or does debt offer better risk-adjusted stability? This session examines where the risk-reward equation truly lies and how investors should position portfolios for the year ahead. Joining the discussion will be Ashish Gupta, CIO, Axis Mutual Fund, Rishi Kohli, CIO of Geo BlackRock AMC, Trideep Bhattacharya, President and CIO, Edelweiss Asset Management Limited, and Chirag Mehta, CIO of Quantum AMC. Please welcome them with a big round of applause.
Thanks so much, Nandita. So this is definitely something that concerns every single person out here, because everybody in the end wants to know, where should I put my money? Where am I going to make money this year? Last year, of course, 2025 was a very underwhelming year for equities. Most people were disappointed. Only the level of disappointment was different based on, where you really put in money. And on top of that, anybody who was not invested in gold and silver had even more to regret. In fact, you had only regrets. Is this year going to be different? Of course, we've had a 2,500 point reset on one day. That makes up for something, not everything. But how is this year really going to go? So let me start with Ashish. Do you think the market has left the worst behind?
Thanks, Mahalakshmi.
Equity markets.
Sure. Thanks, Mahalakshmi, and thanks, Moneycontrol, for inviting me today. So, first of all, I'll actually say that last year for equities was not really too bad, right? I think there is always what we call a recency bias. So the last few years were so good that last year felt bad, right? And if you look at Indian equities, at least in INR terms, the Nifty was up 10% last year, right? And I think given where we were, given the magnitude of gains that had come in the previous few years, I don't think it was a bad outcome at all. I think we have to keep resetting our expectations. I think people have seen that debt returns have come down, yields have come down, but somehow expectations of equity returns have been kept high as they were, right? So I think if inflation rate is lower, nominal GDP rate is lower, so you cannot expect equities to continue delivering 15-20% return. So I would say that if your expectations are reasonable, then this should still be a reasonable year for equities. We are definitely seeing some of the challenges that had impacted us in the previous couple of years. One was high valuations, that having moderated, particularly on a relative basis. We saw the other big challenge last few years was last 7-8 quarters we were seeing consistent earning downgrade. This quarter, for example, that just got concluded, we have seen the earnings stabilize and better earnings growth is expected. So some of the challenges are behind us, but not all challenges are behind us, right? So we still find that capital flows are not conducive. There are high level of global uncertainties. So I think those challenges will also be there. There is also a huge pipeline of equity IPOs that will continue to come in. So I think it will be therefore a year of modest gains. But as long as people have reasonable expectations, I don't think they will be too disappointed with equities this year.
True. So, you know, we had a Global Wealth Summit in 2025, and we had a debate around how equities will do this year. And, you know, everyone says, thanks to the tax advantage in equities, there is never a case to invest in debt as opposed to equities, because most of the time, most analysts and fund managers are always projecting a 10 to 12% growth in earnings. And unless you have a case for severe derating, there is no question of thinking about debt as an option at all. So tactically, Tridip, the reality is that equity returns are lumpy. And like Ashish put it, last year's return was not as bad. It just looks really bad because you were benchmarking it against 2021, 22, and 23. This year, practically speaking, what do you think the markets will do? Let's not think about the tax equation. Let's not think linear. How do you think the markets can do?
So versus debt, just to give you, our tariffs might have come down from 15 to 50 to 18. But it is still 18% higher than what it was about 5 years ago. Likewise, against most other countries, the tariffs are meaningfully higher than where they were about 10 years ago, right? So basically what I am saying is that we are in an inflationary world, right? That inflation which was hovering around 0.5%, you know, is now gradually inching upwards structurally, not just 2026 or a year later. So if we are in an inflationary world, then the best asset class to own over the medium term that can beat inflation is equities at the expense of doubt. There is no question about that. There can be periods where we go through earnings downgrades like we went through last year, and as he explained, last year we actually saw somewhere around 13 to 15% earnings downgrade coming through in Indian equities, right? It was election period, no decision making got made. And hence equity did what they did. Despite that, as he quoted, about 10% return, better than a classic FD. So at times when earnings are improving, and at times when ultimately we are going to be inflationary, then I think, in my opinion, there is a zero iota of doubt that barring asset allocation, where you have to allocate some part to debt, between equity and debt, equity in an inflation environment is the way to go. On the other side, if you have to drive protections, maybe real assets is the way to go about it if you complete the asset allocation spectrum. But between these two, I would choose the two extremes: on one side equities and real assets on the other side.
So like he's saying, tariffs are higher than the previous year. Of course, they're lower from the 50% to 18%. But this year, you also had, very abysmal level of inflation. I mean, very, very low level of inflation. So is the assumption that it is going to go up significantly? In which case, what do you think of interest rates? Are we going to look at some capital erosions as part of the equation if you were to invest in a debt fund? What is tactically, where do you think debt stands?
First of all, thanks Mahalakshmi and Moneycontrol for inviting me to speak, and very happy to share the dais with a lot of much more mature AMCs, since we are among the newer kids on the block. Now, coming to the question and the overall topic, so I think Ashish and Tridib summarized it pretty well on the equity side. Overall, my view also is on similar lines regarding equity being very interesting for the coming year to 2 years, because obviously the correction that you saw and the halt in the equity markets that you saw since October 24 was largely to do with the over excesses that were there both on the valuation front, generally in terms of price performance and related things. And since then, obviously, the earnings growth had disappointed, right? Which seems to have minorly turned around the previous quarter. This quarter, so far, again, minor improvement. Obviously, I think 2 or 3 quarters of sustained, performance on that earnings growth side is required typically before sentiment really comes back with a bang. And even from a Capex kind of perspective, right, which we had seen that corporate Capex is not coming in. But now, again, there are some initial signs of that coming in. That would, again, happen once the March quarter also goes by. So if there are further improvements, then I think post that you're going to see a great 1.5 to 2 years. On your specific question around inflation and interest rates, I think largely, there is pretty much consensus and, no very different view from that we are definitely at the end of the rate cut cycle, right? My view is that we are done. I mean, at max, I think people who are thinking there may be a rate cut would say 25 bips more, but that's it. But what is interesting on the fixed income side, obviously, is that you haven't seen that transmission happening, right? Yeah. And you still have the long-term yields at the same levels as when the repo was 1.5% higher. So that obviously leads to certain complexities on the fixed income side. So tactically, obviously, there are lots of opportunities as a result that come up. But I think from being a sort of a long-term, fund manager, fixed income fund managers are having to take much more tactical and short-term calls. So that's how it sort of changed over the last year. I think it's a passing phenomenon. Things will improve on that front going forward, but that's how it is right now. Given that and the equity view we discussed earlier, obviously I think equity makes a lot more sense. Even when markets were bad, honestly, there were a lot of sector rotation happening. So given that we are very data focused, and systematic and quant as a whole theme for the entire mutual fund, we look at a lot of that kind of data, and history shows not only in India but global markets that when healthy sector rotation is happening, even if markets are dull, it is a sign of an underlying healthy bull market in the long run. And that has been very encouraging, that even when, overall you've been disappointed, the sector rotation has been very healthy, and therefore the role of both asset allocation and then having a diversified and interesting sources of alpha, different sources of alpha, is something one should focus on.
Chirag, what's your take? And I told Tridib, don't think linear, but I always get this answer that, like Ashish also said, if you have realistic expectations of 10 to 12% this year, won't disappoint. I presume that will be your answer too. Or do you have anything different?
No, I think See, when we were in September 24, things were flashing red. All the explanations that my colleagues gave, I think were very, very evident then, and probably that was time to be cautious. Things have improved considerably from there on, and probably we are throwing at this juncture. And probably if the recent quarter earnings were some evidence, probably there is more optimism as opposed to pessimism on earnings trajectory. So I think we are a lot more positive as a fund house going for next 2 years. Probably there can be, given that what we have seen over last 1.5 years in terms of earnings, markets may wait for some more evidence to kind of move decisively higher. But we were very, very cautious. Our cash levels had gone to 20% in September 24. Our upside potential indicators are flashing red. Like our upside potential indicator, which we have been tracking for last 20 years, was saying that equity markets in September 24 would give you 2 year ahead returns of 11% absolute, which was 5% CAGR, which meant that, bonds or fixed deposits were even better than equities. That was a really flashing red sign. Coming now, we have gone higher. If I look at 2 years ahead from this juncture, it is saying that, we are way above what levels we have seen historically in average for last on 2 year basis. So that tells me that our optimism is coming from earnings, and that translating into an upside potential that we look at, and that is telling us a lot more optimism in terms of how we see things. It may be slower to come by, but things have become slightly healthier since last March crash that we saw in Indian markets. And then things that we have seen in terms of action taken by policymakers, by government, that has led to further improving momentum in earnings or economy per se, and therefore the earnings of companies. So I think probably this year can be some moderation over the next 3-6 months, but markets are forward-looking as they see more earnings momentum come through. Probably it will take it in a positive stride, and probably we could be headed much, much higher. So I think last year was a year of moderation that you would have said earlier, but I think it could surprise you on the upside as we go by the year, and then probably in the next year. It can be a little more back-ended, but I think the trajectory is more optimistic from here as opposed to looking at any pessimism.
Right. Tridip, let us for a moment, all of you are saying, at least going by this quarter's numbers, there is reason to be a little more optimistic and think that earnings will come back in the coming fiscal. Is it possible? Because if you just look at the 2008 following period, but maybe 2008 is not a great example, because after the crash, you actually, within 9 months, you bounced back because of all the quantitative easing and all that, and not just India, all over the world. But let's say 2000, and typically you see big peaks followed by at least 2-3 years of flat to consolidating markets. And we've perhaps seen about 18 months of consolidation, nothing more. Is it possible that even if earnings were to come back to, let's say, 10-12%, one should be very, like Ashish puts it, realistic, but I would say a little subdued in your expectations about, whether markets can deliver you that much? Because in the end, in terms of valuation, we are still at the higher end, not at the lower end.
So valuations are actually at mean. It's not really at extremes like it was in September 24.
Fair enough.
But let me put some context around this whole thing. If you look at last 5 years, a lot of the returns have been driven by multiple expansion. Earnings have followed through, but multiples have re-rated across all of this. Yeah. And that was because structurally rates were going down. Now we are on the other side of the cycle where rates structurally are going up. You look at Japan, 30-year, everywhere rates are going up. When rates are going up, it has a gravitational effect on PE multiples.
That's right.
So on one side, while earnings estimates will stand to go up, on an average, the PE multiples would be subdued going forward. And that's why we are saying that, yes, earnings estimates are going up. By the way, that's the first fodder of being positive on the markets. That's why all of us are saying the same thing. But the other part is how much can it re-rate? There, because of this deflationary impact on multiples, the overall returns might be subdued. Once the interest rates stabilize at whatever levels they do, which I don't think we have reached there yet, then the question of non-linearity of returns which you are looking for would actually stand to come through. So we have to tide through this. There are some global imbalances, like, you know, what's happening with dollar, what's happening with the yen carry trade, right? Some of these global imbalances which is outside the realm of Indian earnings and the North Block and the AI and whatnot. We have to resolve through that for us to see a clean world of returns which will be non-linear in nature. Till the time, it will be a bit of a muddle through. From here on, the point that I am making is it will be more global than local. Our issues were mostly last year, where we had no global deal coming through, and every alternate week, Twitter was causing more damage to the P multiples of India than the numbers, where, you know, Trump would make some statement which would not be going well with Indian, markets otherwise. In that context, we now have about close to 80% of our exports well signed in some form of a deal. So those macro headlines are out of are in favor. Earnings are bottoming out. That's as much as we can do. There are global issues which we have to muddle through, and that, my sense is, would have a deflationary impact on multiples. So that's the reason behind a little bit of caution on extrapolating this earnings onto returns. And that's a near-term issue to grapple with.
So this is also precisely my question, that, I mean, if you're assuming a 10-12% earnings acceleration, I don't know whether you expect anything more, because the consensus is not more than 12%. And by the way, whether the earnings growth ever was 35% or 5%, the projection was always 12% in Indian markets. So, but anyway, keep that aside. 12% earnings growth with, you know, multiples derating, that means your returns have to be significantly lower than that.
Multiples,
or your best case will have to be lower than that.
So which is why I said that multiples are today at mean, not at average. So in many ways, it could be in the range of earnings, or slightly lower is what we are thinking about, broadly speaking, in terms of earnings. Now, if you look at Nifty 50 earnings, it's kind of, you know, barring 1 or 2 days movements, it was at 10-year average over the last fortnight or so. Broadly speaking, we are there, which is a good starting point. Relatively, India has underperformed emerging markets and global markets by 40% in the last year. We were seen as an anti-AI trade. While absolute valuations are in line with 10-year average, relative valuations relative to global markets are at 1 standard deviation low. So when people think about asset allocations, these things start to become relevant, particularly if the earnings trajectory starts to stabilize, to move in the right direction. So net-net, we might do relatively well, in my opinion, versus global markets in the times to come. Absolute returns will be a bit about how the global imbalances resolve themselves over time.
Your take, Ruchit. Also, you know, another counterpoint to what he's saying on valuations, which is a conversation we had some time ago in the Bangalore event, I think. No, we had an event in Bombay where Siddharth Bhaiya was present, and my memory is unfortunate that he's no longer with us. He's making this point that if you just decompose the, you know, Nifty valuations and just, you know, plug out all the oil and gas companies and the PSUs and stuff like that, and look at, you know, companies where you want to really buy, the valuations will be significantly higher. It's not like 21 times. So how do you respond to that?
Yeah, so see, for us, I mean, I and our AMC will have a slightly different take on this from everyone else, because, as I said, we are data-driven. We are trying to bring a lot of global best practices here. So we look at it from a very different lens. So rather than saying, okay, you know, equities is going to do, you know, on the margin, we are all positive, I guess, and now the debate is whether it's 5% or 10% or 20%. But then there are many ways to get the alpha. So for example, globally, obviously, you know, one of my parents, BlackRock, has done the research, but many other global large houses, you know, like Robeco and many others have done this research, that there are 3 sources of alpha, pure sources of alpha. One is stock specific, second is sector specific, and third is what locally we call as factor, but globally is called styles, right? In India, we are all focused on, largely, majority on stock specific alpha. Sector specific is again hardly there. And factor style, again, we have some passive, you know, indices over the last few years. I think we are still very far away from constructing them at global standards. So a lot more work can be done there. And then having active funds in that factor style space, again, you have very, very handful funds, you know, 1 or 2 schemes from all the mutual funds. And I think, you know, in a lot of cases, because, you know, you had to launch something in thematic, it sort of got started. So there is very limited sort of data experience and number of funds there. And whatever is there is more like single factor, what is called single factor, that it's only momentum or only quality. But you can have a multi-factor, you can have factor rotation, you can do many other things with that. And on the sector side, even that is missing, right, largely. So what we believe is that we want to get, you know, those kind of alphas to the market. So for example, we launched a sector rotation fund recently focusing purely on sector alpha. So there when you see the portfolio, you shouldn't be looking at stocks, you should be looking at the sector allocations, which is very different, right? When you look at any other fund where there is a sector or a business cycle or something else, there will be concentration in stocks, and therefore a stock-focused and a sector-focused alpha approach is not very clear. It is sort of mixed. Here we want to give a pure sector alpha. So we think that, you know, you can have these kind of interesting strategies. And again, at an investor level or a distributor level also, when you're doing asset allocation, you can combine these different kinds of things and therefore sort of do better than, let's say, what the headline markets may do.
Right, understood. Ashish, looking at the flows picture and especially looking at this this month's numbers, some moderation in equity flows, more money moving into precious metals and so on. What do you think will be the impact of that on markets? Because on one hand you have, because largely the money that's supporting secondary markets is coming from domestic investors. And then if the markets are slightly good, there is also the long list of IPO pipeline that is waiting to come and take away all the money. What is the net impact and how do you see these things playing out?
So I think the trend we have seen last couple of years, not just in the last 2 months, is that certainly domestic flows have picked up both 2024 and 2025. Net mutual fund inflows have been to the tune of about 4 lakh crores. And that has been offset by equal, in fact, slightly higher amount of supply, right? IPOs and secondary stake sales. So I think what we are seeing is that this is kind of balancing it out, right? And to the extent you see a slowdown in domestic inflows, some of this pipeline of IPOs might not even materialize, right? So at the margin, I think we will go back to the 2021 era where the direction of the market is set by the direction of FII flows. So the domestic supply versus domestic demand is going to keep balancing it out each year. Of course, it might not be quarter to quarter perfectly matched, but broadly it will kind of match. Yeah. And so the direction of FII flows is going to more matter than to give. And I think that made the point that on a relative basis, we have kind of seen the correction. So our relative valuations are now attractive. We are now at a larger, our premium to both emerging markets and premium to global markets in terms of PE multiple is at a low compared to history. The challenge, though, that even though we have seen or we are seeing signs of earning recovery, global economy, global earnings and emerging market earnings outlook this year is very, very strong. So while our earnings growth is going up, our relative earnings growth is still not good enough, right? And so while for the month of February we have seen positive FII flows, but it's not really meaningful, right? And January was, if I recall correctly, about $3 billion negative, right? This year, as you said, we are expecting a 13% growth in Indian market earnings, but emerging market earnings this year is expected to grow 22%, right? Of course, a lot of those are kind of commodity-like earnings, what's happening to earnings of some chip companies and memory companies, etc. But on a relative earnings basis, India is not kind of standing out as yet, right? If I look at global GDP growth this year, again is forecasted to be in excess of 3%. US GDP continues to grow very, very strongly. In fact, last quarter, US nominal GDP growth and Indian nominal GDP growth for the same, right? So we are not kind of standing out in terms of premium, in terms of growth and earning, and that's why we are not getting the foreign flow share that we have been so used to. So I think that also has to come back for us to really, as we were talking about, get some multiple re-rating.
Right.
Otherwise, I think domestic demand and domestic supply will kind of balance it out.
Fair enough. Chirag, what do you think are the biggest risks for this year for equity markets?
So I will agree with Pradeep when he said that, most risks are more global as compared to local. So if, say, something goes untoward the trade deal that just happened, if it unwinds or becomes adverse to what we have today, probably that could derail some of the optimism that we have. If growth is slower to pick up, even from an India standpoint, what we have seen is there were a lot of actions like GST cuts, interest rate cuts, etc., playing out in the economy. It does not pick up as such because there are some headwinds to certain sectors, like, for example, exports or be it IT, etc., which are high-paying jobs. So if there is some issues in terms of growth that impacts those sectors, there could be some impact. But having said that, given what we are seeing today, there are certain clear opportunities where growth will be faster as compared to otherwise. And probably you need to take that into stride as opposed to saying that I'll go all out in the market and market will do well on a holistic basis, as opposed to saying that there are certain pockets which will, in the initial phases of growth, will grow much faster as compared to rest of the market. And so it will be more towards picking the right stocks, right sectors that will do well as opposed to a holistic market. So is there a broad market that is likely to do well? Of course, from a valuation standpoint that we have spoken about, that broad market is still slightly more expensive than what we would like to from our comfort standpoint. So from within the markets, there are clear opportunities. Can that derail because of global reasons? Yes, that can derail because of global reasons. But if those were not coming through, then probably we are on a good trajectory from an earnings standpoint.
Right, fair enough. Just one last question to all of you that, if you were to take a tactical call and were to invest only in one asset, bad for one asset, between equity, gold, silver and debt, what would you bet on for 2026?
Equities.
What time horizon?
2026.
Equity.
Same
Okay.
answer.
Gold.
Oh, no, gold.
Yes.
Okay, wonderful. A couple of minutes on gold then.
Sure.
What is the case?
So what has propelled gold over last 2-3 years, right? It's more fundamental structural imbalances in developed world. Look at what's, so if I were to tell you a company which puts in $1.3 in capital and gets $1 in revenue, you would say that company will go bust. And that's been continuing in the US market for last 20 years, right? So it's very, very structural imbalances we are seeing in developed world per se, which is leading to piling of deficits and debt, and that is where gold is going up. So there are very, very fundamental reasons why gold is going up. The de-dollarization, as we talked about, it's talked about more loosely, but there is a case for diversification of reserves and investments into assets like gold, which we think will continue. So I think earnings will be slightly slower to pick up initially, and it will be stock specific. So from a headline equity index perspective versus gold, gold could do well. Of course, there can be a risk of correction which can be near term. But beyond that, if I look at, slightly outward, I think gold would probably surpass equity in terms of its return this year, and probably next year could be reverse in terms of equity doing better than gold.
All right, it is 3:1 equity to gold. But thank you so much, gentlemen, for an enlightening discussion. Thank you so much.
Thank you.
Thanks.
All right. Thank you to Mr. Gupta, Mr. Mehta, Mr. Kohli, and Mr. Bhattacharya for breaking down the asset allocation choices investors face today. And thank you, Mahalakshmi, once again. Before we proceed ahead, let us take a moment to watch how HDFC Mutual Fund celebrates the power of discipline, dedication, and new beginnings, values that mirror the journey of long-time wealth creation.
ये जिंदगी किस्तों से बनती है, जैसे ये पहली किस्त हमारे जज्बात की। ये किस्त संयम की, प्रकृति के नियम की। ये किस्त एक छोटे से सपने की शुरुआत की। ये किस्त नन्हे कदमों को बढ़ावा देने की।
गिर के संभलते जाना तू, उड़ने से ना घबराना तू।
ये किस्त श्रम की, परिश्रम की, गिर गिर के उठने की।
तू राहों के सबक को सीढ़ी बना के चल, छोटी छोटी परवाजों से संवरता है कल।
और ये किस्त दुआ की, आशीर्वाद की।
तू राहों के सबक को सीढ़ी बना के चल, छोटी छोटी परवाजों से संभलता है कल। गिर के संभलते जाना तू, उड़ने से ना घबराना।
ये किस्तें और कुछ नहीं, बस इन्वेस्टमेंट ही तो हैं, जो हम सब करते हैं अपनों के कल को बेहतर बनाने के लिए। तो देखा जाए तो हम सब इन्वेस्टर्स ही तो हैं। जब जिंदगी जीने का तरीका ही SIP है, तो जिंदगी के लिए SIP क्यों ना हो? जिंदगी के लिए SIP।
HDFC म्यूचुअल फंड का निवेशक शिक्षा और जागरूकता अभियान, अपनों के लिए पहला कदम लें। म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
All right, let us now turn our attention to a special conversation. Markets change, cycles turn, but learning never stops. The most enduring investors are not those who predict every cycle, but those who learn from every cycle. For this discussion, we would like to once again invite Mahalakshmi and Navneet Munot back on stage. Please give them a huge round of applause.
Thanks so much, Nandita. Navneet, you have been in markets, you've been on the investing side, you've led investment operations of one of the leading mutual funds. Now you are CEO. Through your journey, tell us what have been some of your key lessons to be a very good investor, because you're also an avid reader, and we have not just distributors but a bunch of individual investors. And if you were to leave them with some anecdotes that taught you something really, some enduring lessons, take us through some of those anecdotes and drill down those learnings, because that's what we want out of this session.
Thank you. So someone said that to achieve satisfactory result is easier than what you think. To achieve satisfactory result is easier than you think. To achieve superior result is far tougher than what you think. And in the long run, a large number of people, just by having the virtue of patience, can achieve a result which would meet most of the life goals. I think that's one of the most underrated virtue. One of the things as investor, I always say that in the long run, how much wealth you will have, does not depend on how much money you make. In the long run, how much wealth you have does not depend on how much money you will make. It will depend on how much money your money makes. And that basically reflects the importance of power of compounding. which, as Einstein said, that is the eighth wonder of the world. Those who get it make the most of it. Those who don't pay for it. I think it's a hugely underrated virtue. I've quoted this many times to keep it simple that the formula for wealth creation in the long run is sound investment plus time plus patience. You take away any of those and you don't create great wealth. In institutional money management, which is like slightly, I would say, different than, let's say, the way an individual manage. In fact, for an individual, I would quote that great wealth is created by knowledgeable concentration. Great wealth is created by knowledgeable concentration. Moderate wealth is created by professional diversification. Ordinary wealth is created by excessive diversification. And wealth destruction happens through poor concentration or neglect. I think we'll keep that in mind. A lot of things are done. The investors make three mistakes in my journey. I've seen that, and I think Charles Ellis or somebody put it rightly that you should avoid, you should be aware of the three pitfalls of investing. Number one is the peer pressure. Of course, as I said, that institutional money management is different. We are always looking at a benchmark and our peers, but as an individual investor, one should not be under peer pressure. The benchmark should be like your life goals. The number two is the media noise, and I know I'm talking to Mahalakshmi, but Mahalakshmi is the one who doesn't create noise, who makes sense of what the noise is all around. So she's exceptionally good at that, but avoiding media noise. And the third is be aware of the inherent cognitive biases that all of us have. And it's so interesting, Mahalakshmi, had we done it, I mean, we had the similar event, I think almost a year back. I don't even remember, did we utter the word gold and silver in that conference? And today when prices have done so well, it's the best performing asset class, and a good part of time today has gone in discussing that. So that again comes from one of the cognitive biases, the recency bias or the bandwagon effect. If everybody thinks that it's good, then it must be good. And one is the recency bias. We just extrapolate the result of what has happened recently. I think these are some of the very basic things to be kept in mind for an investor to achieve their life goals.
Right. So the first thing you said, which is also, investing 101, is this, effect of compounding and having the patience to stay the course with your investments. Why do you think it is so hard? Why is it that something so simple investors don't stick with? Because one of the things even Kahneman says is, if somebody is not doing something that you would think they should logically do, why is it that they are not in that place? What is the root cause, and how do you think one can really pivot? Because this pivot can actually be quite rewarding.
But I think that's to do with the human brain, because some of these biases are very inherent in us. So to oversimplify it, I can say that it's a greed on one side and the fear on the other side. There is loss aversion bias. We're always fearful something can go wrong. And on the greed is when things are good, you extrapolate that. We become over optimistic on one side and excessively pessimistic on another side. That's very basic human nature. So it's not you have to really be very cognizant of it. And one of the best books to read on that, and you have interviewed him, I think, Daniel Kahneman, the system 1 and system 2 thinking. We get driven by the system 1 thinking, the instant reaction, but it has to be a proper response by thinking little deeply. But that's not something that we are wired with. We are wired as a species for tens of thousands of years with a fight or flight attitude. We were fighting for our survival on a day-to-day basis, and some of these things have got deeply wired in us. So to be aware and to think long term is something that you have to work on yourself and keep reminding yourself constantly. And that's where also the role of an advisor or distributor, that somebody who can make you aware. Investing is not about, the investing success is not about how much you know, it's about how you behave. And many people have said this in many different ways, but to put it most simply, that a long-term success in investing is not about how much you know, but it's about how you behave. And that behavior is something that everybody needs to work a lot more. There's too much of emphasis on knowing more, and I've quoted this many times that these days there is an overload of information which gives you an illusion of control, which gives you an overconfidence because you think you know more. You have a WhatsApp and many groups where so much of information is flowing to you every minute from all sources. You have all the X and Facebook and whatnot, and then all the Telegram channels these days, and so many of the influence, and apart from the 24/7 TV channels and the newspapers, so on and so forth. And that actually gives us an illusion of control and knowing more. But I've quoted this several times, that data is not information, information is not knowledge, knowledge is not understanding, understanding is not wisdom. You create wealth through wisdom. I don't know what is the appropriate Hindi word, but that would probably be Vivek. I think it's a Vivek which is more important than maybe Jada, I don't know, Buddhimata.
Right. Interesting.
There is a word in Bhagavad Gita called Isthit Pragya. So he says that Gyan Vigyan Triptatma Kutasto Vijitendriya Yukta Uchyate Yogi Samlostashma Kanchana. And I always think that there is some relevance with, while he talks about the best yogi, the qualities that one needs to have, but if you see the smaller part of that, it's just that if you are endowed with knowledge and special knowledge, Gyan and Vigyan, Kutasto Vijitendriya, which is like if you can win over your senses. But that in investing from the relevance of investor should be like if you can win over these two biases or these two instincts, which is the greed and fear, then you are a good yogi. I mean, you achieve
No, you're
good result.
absolutely right, because one of the biggest learnings of Bhagavad Gita is about control over senses. And, this is also the foundation of, what Buffett talks about, and a lot of great investors have talked about, that, be fearful when the markets are greedy, be greedy when the markets are fearful. All easier said than done. But
and one of the reasons is because, as Ken said, that markets can remain irrational for longer than you can remain solvent. So if you have a highly contrarian call, and sometimes being contrarian can also mean like you are overconfident, you need to have respect for market. There is wisdom in the crowd, but at the same time, crowd becomes like, it becomes mania of the mob. And differentiating between these two is easier said than done.
Correct. No, so the question I was about to ask you is, for all the points that you've talked about, whether it is patience, the compounding, and also the contradictions and dilemmas that you face when you're experiencing what you're experiencing with respect to markets, right? Like, for example, if the market is going down 20% and your fund is underperforming, or your stock has gone down 40%, you can never be sure whether you should, is that the point where your patience is being tested? Should you correct it because the call is wrong? Or should you stay the course because you need to be patient and stay the course? Tell us some of your dilemmas and how have you sort of resolved it? Is there a checklist or anything that you have which helps you stay the course?
So there is a thin line between conviction and overconfidence.
Right.
Very, very thin line between these two. So the way to do is like you constantly keep checking your thesis, whether the thesis is right, whether the being contrarian investor is easier said than done. As I said, that crowd has a wisdom, market has a wisdom, and then there are many examples I can give you. I think classic would be like the markets fell sharply in like March 20, from February 20 to March 20. I think Nifty was down from 12,000 levels to 7,700 within few weeks. And by that time, there was hardly any case detected in India. But over the next couple of months, I mean, every day you were seeing higher and higher number of cases, and market was going up. And that was the wisdom in the crowd, that while it's getting more pervasive, but it is not end of the world. Ultimately, the human ingenuity will ensure that we overcome this crisis also, the way we have handled many bigger crises in our lifetime. So there is wisdom in the crowd, but there is at times it becomes many of the mob, and only you get wiser only with the benefit of hindsight. But more important is, as I said, that is it overconfidence or is it a true conviction?
Yeah.
I think over a period of time, there is no substitute to experience. A lot of people say like intuition, but that gets built with experience over a longer period of time, going through many cycles. Also, I think one of the help can be through by reading, right? I mean, as Wanga says that, I think a lifetime wisdom of any person is like captured in few hundred pages, and there's the best investment you can make. So going back into history is very relevant. The another thing is, I always say that for the in investing, it is not only about reading the books related to investing or business or markets, but a lot more about history, about psychology, about anthropology, about like human behavior. All of those are like as important, because ultimately, I think who said, the Richard Feynman, that if neutrons had feelings, then physics would have been like very tough. And many people said that I can predict the motion of stars, but I cannot predict the human emotions. And market is like the collective place of like all the emotions of millions of people. So dealing with that, again, going back to that whole thing about having the right temperament is a lot more important than knowing more.
Right. So if you were to summarize, because you've made a lot of points, you've talked about patience, you've talked about the compounding, the magic of compounding, you've talked about not to over diversify, have the right amount of diversification, you've talked about having control over your senses and having the right temperament. If you were to just pick one thing as a ritual that you need to practice, or any regimen that you need to follow to better your own outcomes and have the temperament that you require to succeed in the stock markets, what is that?
So our biggest focus as an AMC has been on investor education. You just saw a glimpse of it with our Zindagi Ke Liye SIP. And our idea is the whole life is SIP. Everything that you learn, you become better over a period of time is like SIP. Can we look at investing in a similar fashion? And I think keeping that discipline is the most important. You will get swayed by those emotions. You will get swayed by the volatility. But every time remembering that, I mean, you don't have to go back to hundreds of years, but just look at the history of last 30 years, and some of our funds have been around for that long, 32 years, and you can see that across many of these cycles, across many of these ups and downs, there have been global cycles, there have been like business cycles, different kinds of credit cycles, different kind of economic and political cycles. But through this period, I think the way to get ultimate success has been through just remaining disciplined across all of these periods. Yeah.
True that. Just remain disciplined across, and that's the secret to success. Thank you so much, Navneet. Such a pleasure talking to you.
Thank you, Mr. Manoj and Mahalakshmi, for that enlightening conversation. Moving on, from system building, we now move to strategy. GIFT City is rapidly emerging as India's bridge to global markets, enabling offshore fund structures, international products, and cross-border capital flows. But with opportunity comes complexity. What does GIFT City truly enable? What challenges remain? To explore this, let's welcome back Mahalakshmi. Please welcome our experts as well. Dr. Dipesh Shah, Executive Director Development at IFSCA, Pradeep Ramakrishnan, ED at IFSCA, Vaibhav Shah, Head Products, Business Strategy and International Business, Mirai Asset Investment Managers India, and Vandit Shah, Senior Director and CEA, Price Waterhouse & Coopers Limited. Ladies and gentlemen, please welcome them with a huge round of applause.
Thank you so much, Nandita. This is an exciting panel. We're to be doing in Ahmedabad, because this is also the city, the gift city. The reason we wanted to curate this panel is a little different from the reason why Gift City itself was created to begin with. From a policy architecture point of view, Gift City's conception, the idea behind Gift City was to be able to attract foreign capital through Gift City, which could compete with, Singapore or a Mauritius and so many other destinations, and bring that into our own country. Be that as it may, today the appetite for Indian investors to invest abroad seems to be a lot more. At least there is a lot of noise around it compared to, the FII interest in India. Very happy to be doing this panel. And before we, get into the thick of conversation, first, let me ask Mr. Dipen Shah, thank you so much for joining us, Dipen, to give us a little backdrop or overview on how has the journey of, developing Gift City been so far in terms, and where have we reached in our vision to be able to make this as a destination, a preferred destination for foreign investors of all kinds to transact out of India and put Mauritius and other destinations out of business?
I think, good evening everyone, and thank you for having us here today. I'm really happy to see the skyline behind, because this is a new Gift City for us, the new skyline which I can see. Probably this also visualizes that how the Gift City looks probably in few years from now, and also when you visit now, you can see the skyline coming up in Gift City. But just for, as myself and Pradeep, we do many of these sessions together. Normally, first question that we ask to the audience is, how many of you have visited Gift City? If you can raise your hand. So there are majority of the people who have visited, and there are still many within Ahmedabad who have not visited Gift City. So I think the first thing is seeing is believing. You should come and see Gift City and see for yourself as to how it is coming up in terms of what it is trying to achieve. But just to quickly tell you about why Gift City and where it stands and what is the future looks like. Gift City, as you know, is an answer to India's offshore center. How do we create an offshore center within onshore India? And when we say offshore center, meaning that how can you do the international financial services business more efficiently sitting in India? And I think we've been used to being sold to Mauritius, we've been sold Dubai, we are sold Singapore. At some point of time, I think all the consultants and the law firms that we visited, I think they had the booklet of doing business in Mauritius, London, New York. There was no booklet on doing business in India or in GIFT. So our question to them was, you all are selling Mauritius, Dubai, Singapore, everything. What about doing business in India and doing business within the Gift City and the International Financial Center? I think the problem statement that they defined was that it is difficult to do international financial services business sitting in India, and probably that is one of the reasons why many of the businesses would have gone to Mauritius to do India structure sitting there. And I can see, people like Navneet now creating their structure in Gift City for people to invest into India, and so many others, including Mirai and all, which are on this panel. What the IFFC and the government is trying to achieve through Gift City is that you don't need to go outside of India to do India international business. So that's the first point of call, that you don't need to go out of India and export your business and jobs outside. You can be in India to do dollar or foreign currency business. That's the first, I think, the problem which the GIFT is I would say, has addressed, and on an ongoing basis it is trying to address the issues which comes up. The second problem statement was that when I go outside, my tax rate is very competitive. In fact, if you really ask me, out of the 1,200 licenses that we have issued, the single most factor for people to come and set up in GIFT, and many of people here also would agree, was tax. That I go to Dubai, I get 50 tax holiday. I go to Abu Dhabi, 0% tax. And, Labwan, even in Malaysia, 1980s, they created 3% tax. So in India, it was, when we started, it was 18% MAT, and then you have a 35% of corporate and foreign companies, it was 40%. So obviously the benchmark was very high versus what was the competitors. And full credit to Government of India, the way that they really evolved the IFFC, they really benchmark. Now we have, and in this budget I'm sure you would have seen, out of 25 years, 20 years there is no tax on the business profits that you do. So 20 years, zero tax on the profits that you earn in GIFT City. And after that you have 15% tax regime, which again gives a lot of long-term clarity to people to do business from GIFT. So this were, I think, primarily two factors. One was the foreign exchange law, another was the tax law that people were going outside. And if I come to where we stand now with this policy changes, obviously one major important policy change which government did along with those two changes was to bring in a unified regulator within the GIFT City ecosystem. Now, I think all of you are used to Sebi, RBI, IRDA, PFRDA. I was told by your colleague that Moneycontrol, this is first time you are in Ahmedabad. And I'm sure that now with the GIFT City ecosystem, I was telling her this is just the beginning. You know, that the people like Moneycontrol will be doing so many other events within GIFT City for investors which are present here. So now GIFT City presents probably an answer to many global structures. We have 1100, 1200 licenses issued. And if you see the breakup of the firms, you have 35 business segments which operate in GIFT City. It's not that you have only a stock exchange or a bank operating, even a finance company, a treasury center, an insurance firm, everybody, even an aircraft leasing firms are operating within the GIFT City ecosystem. So where we are moving probably is now, as you said, you know, if you ask 10 people, probably 8 to 9 people will say, I don't need Mauritius to do India business. And we can tell very confidently that people don't need Mauritius to do India investment structures. In fact, we have funds which have relocated from Mauritius into GIFT now and to do India investments. If you ask, are people going to Dubai for doing India dollar business? I think to some extent, for commodity trading, people are still going there. But for financial services, for banking and investment and insurance, I think even Dubai, we can say to some reasonable extent confidence that people are staying in GIFT versus going to Dubai. But I think your comparison will be third, which is probably Singapore. Have people stop going to Singapore to create India structures? Answer is no. People still go to Singapore to do international and India structures. But the cost of operating in GIFT City has become so competitive that even now the questions are, do I need actually a Singapore structure? I can do that at maybe 20-30% of the cost. So we are seeing those structures also coming into GIFT, and probably that is a testimony of this 1100, 1200 firms which operates, and every year 300 firms are coming into GIFT. So that's a, you know, answer to your question is we are seeing the roadmap of it emerging as a preferred destination now. But are we really a global financial hub, or what is our aspiration? I think we should become truly a global financial hub, which is like comparing ourselves with probably London and New York, which we, you know, globally everybody consider it as a global financial hub. If you have to really go there, I think there are two things which are really required. One is probably confidence of our own people that we can create a global financial hub within India, and probably believing that the Indian government and the Indian ecosystem can do the same. Because when we used to visit this financial center outside, I think out of 10 people we met, 7 or 8 people would be Indians in those financial centers, helping that financial center to grow. And when you ask them, what are you doing here? They said, we are into financial services. And probably, I don't know, out of 7, 5 would be Gujarati for sure. Because in Gujarati, it is more financial services. So our own people going out creating those financial centers is probably now an opportunity for us to stay in India and create India's own global financial hub. And the second challenge that we see is probably the benchmarking that we do. You know, every year we go to the tax authorities and regulatory authorities. I think that continuous process has to be at a scale and size that at one go, if we are able to do many changes together and make sure that on every count we are comparable. You know, it's not that one business goes live and then you knock the door of a regulator or probably the tax authorities that change the tax law. If we can do the whole piece at one go from now onwards, then probably in 5 to 10 years from now, we can very confidently say that we have come closer to where London and US looks like as a financial center.
Do that. Pradeep, can you sort of elaborate on the funds landscape in Gift City?
Thank you. Good evening, everyone. So I've been in the Gift City in the IFSA for 2 years now. Before that, I was with Sebi. So that's a different fund landscape. Now here we had a regulation called the Fund Management Regulations in 2022, 21-22, which of course had a lot of provisions, and that actually kick-started what you call as the institutional investor participation here in the Gift City. So, and over a period of time, in fact, like Dipesh very rightly said, the fund ecosystem is possibly the most vibrant here. We have got out of this 1,000 odd entities that Dipesh had said, almost 1/3 of them is our fund management entities, or funds and fund management entities, which actually goes to show the robustness of the fund management ecosystem. And why is it that way? It is that way because of the fact that we have encouraged both inbound and outbound. And initially when it started, it was a lot of outbound, which started, but I can also say with confidence that sort of a lot of inbound. There was a lot of inbound. And of course now a lot of outbound has also started. But I'm also happy to tell you that we are also becoming a hub for outbound to outbound, which means that NRIs and other foreign investors are also looking at the IFSC as a place to, probably invest through, right? So, which is also a growing testimony of the fact that we are probably in some way inching towards what can be called as an international finance center. Now, when we, like Dipesh again very rightly said, talked about, a London or a Singapore or a New York, and these are all benchmark global centers, and they have left a lot of things for other financial centers to learn, right? Easy ingress, egress, right? And consistent tax policies. So these are things which we have also tried to bring here in the Gift City. While the tax piece is something which we have been solving, there are minute tax issues which concern certain, certain outflows and also inflows, which have been sort of ticked by the IFSCA in consultation with the CBDT over a period of time. So this led to the new fund management regulations, 2025. And I can tell you how dynamic this whole ecosystem is, because though we came up with a regulation in 2025, now by now the regulation which has undergone the maximum number of amendments is the fund management regulations. Yeah. So it's not to say that our policies were probably not up to the mark, but the fact that the industry itself is so dynamic. So the first 3-4 years of the gift ecosystem, the non-retail portion was very vibrant. We had restricted schemes, we had a lot of investments from institutional investors, high net worth individuals, etc. Now, after the 100% piece from NRI piece was ironed out in consultation in cooperation with Sebi as well as the ministry, the retail piece was actually fixed. So in the last few months, probably in the last 1 year, I can say that the mutual fund industry has taken off, because for the vibrancy actually to any ecosystem comes with the number of participants, and non-institutional investors can only do that much, right? You really need retail to make up the numbers, and which also sort of contributes to the the vibrance of that particular ecosystem. So that has taken off, and I'm very happy to tell you that while money comes into the gift ecosystem from almost 70 countries, money goes out to almost 30 countries, which means that it is not just a one-track pony, it is not just something which is just an inbound thing. And if an international finance center can actually be called that, it has to be agnostic to, the outflows or inflows. So that is what we are also trying to become. And recently we have brought some 2-3 reforms. One is what we call as the platform play, which allows existing fund management entities to sort of to handle third-party funds. We also brought in some co-investment schemes to handle larger investors, and we are also and of course our green channel has allowed companies to just file and go ahead. So the processing time has been amongst the fastest in the world. So, but we continue to make changes, and after all this, still we have got representations from, the other two panelists here saying that, okay, we still have a wish list. So I understand that this wish list can never get over because there are a lot of things that we have to learn to iron out. But what you need as a regulator is to be patient enough to listen to these things, right? And also not be afraid to go back on certain things which you brought in earlier. Because particularly with the fact that the world markets are so dynamic, a lot of new things keep coming in. So we should not be afraid to go back on something which we brought in earlier. Of course, what we do that right by consulting everyone. We have a very robust consultation process. We consult all the participants as well as the public. And ultimately, what is enriched is everyone gets enriched because of that.
Sure. Quickly, that's an interesting thing, how long this whole ecosystem has come up, especially from a funds perspective. Vaibhav, how do you see Gift City as an outbound investment vehicle compared to everything that is available in the market today?
Thanks, Mahalakshmi.
And how easy or difficult is the navigation actually from an investor's perspective?
Sure. No, thanks for first inviting me on this panel. So, I've been talking about Gift City for last couple of years. A lot of people say you don't represent Mere Asset, you represent IFSCA. So, just reiterating that I'm Vaibhav Shah, representing Mere Asset, but it's a job for all of us to represent Gift City because it's for us to create this entire ecosystem. And this ecosystem, like Dipesh sir mentioned, can only happen if we are all convinced that we want to make India a financial big center. So this can happen. I meet a lot of distributors and they say, we are happy selling mutual funds in India. Of course, I've been selling mutual funds in India for 20 years and I continue to sell mutual funds, but nothing should stop you to even sell Gift City products because you're able to get from the same investor now access to dollar investments, which earlier you could not, and you could only give access to INR investments. So it's actually broadening the pie for a lot of distributors. And like you rightly pointed, so we started earlier when we also started, we started with inbound funds because we thought NRIs and foreign nationals can easily access India, and we got some success there. But in the last 12-18 months, you would have seen that Indian market has sort of underperformed most of the global markets. And that's because India is sort of underrepresented in many sectors like AI, semiconductor, rare earth, blockchain, etc. The world is moving towards a lot of new age technology where the participation on stocks is much higher in global markets. And I'm sure Indian investors would want to get access to those sectors early rather than wait another 5-10 years to access India. India remains sub 5% of the world's market cap, but I can bet most Indian investors have 95% of their wealth to India. And maybe it's a job for advisors and manufacturers to allow them to invest globally. Unfortunately, through mutual funds for the last 3 years, even if we wanted, we couldn't give them access because of, $7 billion limit on stocks and ETFs. Gift City is giving us an opportunity to be able to provide investors globally and access to best of the funds available globally, countries like China, US, Japan, where some of these sectors and themes are doing better. So the response, I would say, for outbound funds have picked up quite a lot. And I can say because we are also having an outbound fund, the interest investors have to invest now globally is finally coming out. Last year, maybe gold, silver did well. Maybe India should come back, but as Navneet sir mentioned, you should have asset allocation everywhere. So you should have India, you should have gold, you should have silver, and then definitely you should have global equities as part of portfolios. And you can't be 95% only in India, and that's where outbound will become very, very important.
Fair enough. Vandit, you interact with a lot of institutions who want to actually set up, so you in a way facilitate institutions setting up their outfits in Gift City. From their perspective, how have things changed? Are there any pain points that you still feel needs fixing? And how much traction and which pockets are you getting traction in?
So firstly, thank you for having me here. So generally when we work with institutes, like if you see the trend which has been following, IFSCA has now come up with SWIT portals, and it's there since a long time now. And there is responsiveness from IFSCA. So if an institute which used to set up in GIFT City earlier used to take an X amount of days, have now come down to 2 to 3 months. Like any license that you take in IFSC, you get it in 2 to 3 months. That's like one of the fastest that we have seen any regulator giving a license across geographies, not just India. And you can look at other geographies also. A financial service regulator generally takes time to give a license. That one single pain point had been addressed by IFSCA from the day they started, rather. So that was one thing that they always promote, is ease of doing business. The second thing that they do is the consultations with the industry, as sir mentioned. So they'll pick up the pain points, they'll address those pain points. And in terms of the flavor that we look, the trend that we look on the fund management side and in the mutual fund side is the outbound flavor. So earlier, there were a lot of funds who were first investing into India. But now if you see, there's a lot of demand in terms of moving money from India to invest in overseas stocks. So a lot of consultation there was required with RBI and other regulators, which IFSC definitely being a regulator speaks, addresses those issues, helps industry players, answers those queries and help them set up the shops in GIFT City. So if you see last 6 months, you will have seen a lot of funds now looking to set not only outbound retail, but even AIFs and other funds as well to invest in overseas market.
True, true. So this is an interesting trend, and we might just run out of, we have run out of time, but I still want to ask you one question, Pradeep. One of the things about the mutual fund industry is there was appetite for investing abroad, and there is the $7 billion limit that, RBI was uncomfortable with it. We have a cap that has been going on for quite some time. Do you see, and GIFT City in itself was conceived with a certain purpose, which is, making attracting global money to India and make that the hub. Now, the demand and appetite is really coming from a quarter that the central bank is not maybe comfortable with. How do you look at this whole situation in terms of how the GIFT City ecosystem evolves, or how friction-free it can become to facilitate, outbound out of India?
See, firstly, I think we are not a separate nation with a separate flag. So we are part of India. So largely, whatever we do will be bound by the rules of the central bank. And central bank has its, central banks of all the countries around the world have the reasons as to why they do what they do. And as far as India is concerned, the central bank has very clearly said when it comes to outbound, there is a limit of $250,000 every year through the LRS, which I believe is being used presently through through the mutual fund to the mutual fund route outbound. And secondly, we have also brought in something very attractive called the global access model. So this global access model, which actually is probably one of the most hottest things right now, and I'm sorry to say that in the fund management summit, because the brokers are the ones who are going to walk home with all the money. So the global access is something which allows Indians and even international parties to invest through the GIFT IFSC in international stock exchanges. And this has helped because it gives you an additional avenue to invest. And like imagine holding an Amazon stock, an Nvidia stock, or probably a stock of a very hot company in Brazil, or probably a TSMC stock. So that is something which gives you an additional impetus. So this has seen a lot of traction. A lot of brokers have taken licenses. In fact, as we speak, we have got close to 30 odd applications under process for brokers to take licenses as global access providers, or introducing brokers for these global access providers. And we are also having international brokers coming forward to take these licenses. So this is an outbound flavor.
Right.
So this, I believe, the GIFT IFSC is actually acting as a good conduit for Indians to invest abroad and what you call as global access.
Right, fair enough. We'll have to really wrap this session here. I'm sorry because we've run out of time. But gentlemen, all these four men are going to be here for some time. Maybe any of you want to catch up with them, please do feel free to talk to them on the floor. But thank you so much, gentlemen, for joining us today. Thank you so much.
Thank you, everyone. That was a very, very insightful discussion on how GIFT City is shaping India's global investing landscape and the road ahead. Moving on, as markets move through a reset phase, the narrative is shifting. Broad themes and headline-driven rallies are giving way to more selective, bottom-up investing. In such an environment, the idea of chasing multi-baggers often overshadows questions. How do portfolios actually deliver consistent, risk-adjusted outcomes across cycles? Is performance about finding the next big winner, or is it about construction, allocation discipline, and managing downside risk? Well, to guide this conversation, please welcome on stage my colleague Anisha Kumar. And joining the discussion is a seasoned investment professional who has navigated multiple market cycles and brings a sharp focus on portfolio construction and long-term consistency. Ashish Gupta, CIO, Axis Mutual Fund. Please welcome them with a huge round of applause.
Thank you so much, sir, for joining us again. So whenever we talk about, stocks and other stuff, multi-baggers is something that everybody is like, finding the next multi-bagger. So I wanted to understand from you, how important you think it is to find multi-baggers when it comes to the entire process of wealth creation?
Sure. I think, obviously, as the name itself tells, right, all of us will do to find multiple multi-baggers. But I think investing is about the long term, right? And really, even us as fund managers, right? We always tell people that what is most important is time in the market, and not timing the market. And for really having people invest with us for longer periods of time, we have to give them a more consistent experience. We have to give them an experience that kind of prevents them from redeeming too quickly or too short time frame. And therefore, as much as returns matter, risk also matters, right? So when you construct a portfolio, it is not about just discovering a stock. It is about having a process, having discipline. You have to have a portfolio that manages different cycles of the market well. And therefore, while the quest is to find the best stock at the best price, right? But really the challenge is also what is the weightage you give, what is the position sizing you do, because drawdowns matter as much as really returns.
Obviously you mentioned that there's much more to, portfolio management and wealth creation. But so we often talk about diversification when it comes to a success for portfolio. So what level of diversification is the key? How do you ascertain that?
Sure. So I think we cannot have any one stock, right, determine the outcome of the portfolio, right? And as much as we want one stock to deliver the maximum alpha for us, we cannot have a stock have a disproportionate impact in the time of a drawdown. If you look at some of the best multi-bagger stories over the last couple of decades, right? In India, there have been HDFC Bank, Asian Paints, Bajaj Finance, whichever stock you own, and I actually pulled out some data. So if you look at the current top 250 stocks in the country, about 40 stocks have been 10 baggers in the last 15 years or so, right? But the interesting part is that on average, even these stocks have seen a drawdown of at least 60%, right? So the median drawdown, these 40 stocks which have been 10 baggers have seen a 57% drawdown, right? So when you size a bet, right, you cannot have it in a quantum that it affects your portfolio disproportionately. If you have a portfolio, you typically are dealing with multiple level of uncertainties, right? So all equity investing is about uncertainties, right? We can never be certain about a company, a management. Even if a business is good, management is great, there can be external events, there can be technology changes, there can be regulatory changes, right? So you have to manage multiple risk and multiple uncertainties. Typically, if the outcomes are very clear, if a business had delivered multiple years of good growth, its franchise is very strong, then the business also carries a valuation risk. So if the business risk has been taken care of, there's a valuation risk because the market will already be pricing it at a relatively high multiple. So typically you would start with a position of 2, 3, 4%, and if the business keeps compounding, that position can go to 7, 8, max 10%. That's the Sebi allowed limit. And I actually believe that even if your bet is about 3, 4%, it can still make a significant contribution to your portfolio, right? And if you look for portfolio that have performed exceptionally over time, it will have a combination of stocks that together give this outcome. It will never be any portfolio that has one winner that is going to drive all the alpha. Of course, in hindsight, in narratives, you will talk about one stock that was the winner, etc. But really, it's a combination of stocks that gives you the portfolio outcome.
But sir, has this changed for you? I mean, the market has changed over the years. So when you look at, diversification, when you look at, finding multibaggers, has that changed for you over the years?
So I think, of course, market goes through cycles, and a lot of it is to do with the congruence with the economic cycle. And I think in that we do look at not just as much as single stock weightages, we look at the shape of the portfolio, right? What are the weight of top 10 stocks? What is the weight of top 20 stocks? What is the weight of top 30 stocks in the portfolio? And that really drives the outcome. So let me give you some context. So if you, for example, go back about 10 years, right? So the period 2012 to 15 or 15 to 20, portfolios were much less diversified, right? If you look either on a sectoral basis or if you looked even in terms of number of stock basis, because only a few sectors in the economy were doing well, right? So you only had the consumer sector doing well, very select financial stocks doing well, and the broader market was not doing well. If you fast forward that to the last 5 years, multiple sectors are doing well, right? So it's not just financial sector or the consumer sector. You had industrial companies come up, B2B companies come up, sectors like hospitality, hospitals, travel, real estate, multiple sectors started doing well, and therefore they needed to be part of the portfolio, so the portfolios became more diversified. So 5-7 years ago, top 10 stocks tended to be, for us at least, almost 60% of the portfolio, right? Today, that number is probably around, depending on the scheme, between 30 to 40% of the portfolio.
Okay. So one just last thing. So how often do you now, approach portfolio review? Is it like an ongoing thing or is it a daily thing? How has that changed?
Yeah. No, so I think that has not changed. So the portfolio review is constant. It happens at multiple levels. We have a very detailed process about it. One is, of course, it happens at the fund manager level on a live ongoing basis, but we have more scheduled cascading reviews that happen. We have various committees. We have the investment committee, allocation committee, so there are multiple levels of consistent reviews that happen. We also have lot of quantitative flags that tell us. So if there's a movement in stock, there's a change in earnings estimates that demand relook and I'm sure other AMCs follow similar processes. So whenever those flags come up, even if there's the scheduled review is at a later date, these will call for the time to action.
Always wonderful to talk to you, sir. There are obviously a lot more questions, but we're off time. But thank you so much.
Thank you, Anisha.
Thank you, sir.
Enlightening conversation. Let's move on then. As participation expands across geographies and investor segments, the strength of the mutual fund ecosystem increasingly depends on empowering distributors with the right tools, communication and support systems. To guide us on this path ahead, let's welcome Hanisha Vadlamani, Chief Brand Officer and Head of Corporate Communications at KFin Technologies on stage. She brings deep expertise in brand strategy, investor communication and strengthening industry partnerships. Please welcome her with a warm round of applause.
Thank you so much, Nandita, for such a great welcome to me. Good evening, everyone. Kem Shota me? Wonderful. I would like to see some energy before we begin the session because this is entirely targeted towards the distributor empowerment. So let me begin. Good evening, everyone. Respected Sri Amarjit Singh, whole-time member of Sebi, my esteemed colleagues from the industry, and the most important audience here today, the distributor fraternity. It is an honor to be here today speaking to you all. I want to start the conversation with a simple phrase. You can see it on the screen here. Knowledge is power. How many of you in the room will truly agree with me? I would like to see a show of hands, please. Wonderful, wonderful. So I see that most of you agree. Today, we aren't talking about just platforms or products. Being in the state of our beloved Prime Minister Modi ji, we are going to talk about the vision of Vikasit Bharat 2047. To reach a $30 trillion economy, we must solve the one critical problem that has been bothering the distributor community for a while now. It is the distribution, the fragmented distribution. So at KFin Tech, we believe that the hero of this story is the distributor. But as we all know, even a superhero needs a great armor. Historically, there has been a lot of divide, which I personally would refer it to as a digital divide. Because large institutions, they were always able to invest the capital for high-end tech, while the independent distributor faced a tech tax. At KFin Tech, we believe that your knowledge and service should be enough for your primary qualification for success. So moving on, this is the exact philosophy and heartbeat of Ignite. Ignite is a comprehensive distributor empowerment initiative. We are not just trying to provide a platform, but we are actually looking at building a growth ecosystem to turn distributors into finterpreneurs. You are your entrepreneurs, and we would like to coin the term finterpreneurs. So we are currently rolling out the Ignite Knowledge Series, and it goes far, far beyond just basic training. So a lot of the industry experts who spoke before me on the panel discussions were referring to how SIF is the next future of investment. But what are we doing to empower or provide the knowledge as to how the distributor community can actually learn how to invest or guide their investors into investing in SIFs. So we have created training sessions as part of the Ignite series. We are giving NISM Series 13 certification, which are available on our YouTube channel. And we are also doing podcasts with industry experts. So we are bringing industry leaders directly to your headphones to discuss market shifts in real time. Also, we are doing in-person distributor meets. So just like this mutual fund summit here, we are doing, as part of the K-Fintech Ignite series, we are doing a series of investor distributor meets wherein we are coming to the tier 1 hubs and the tier 2 cities. We are coming to you to listen to you, to learn and grow together along with you. And along with this, the best part of it, what's in having a little bit of success, and what is success without a bit of recognition, right? So recognition, we are giving awards to all the distributors who have been performing well and who have been excelling in their own particular AUMs. So we are also taking feedback support, grievance resolution, and robust incentivization of all your achievements. So whether it is using group SIPs to institutional wealth, in corporate payrolls or digital NFOs, for instance, the ARN tagged subscription links, Ignite provides that all that equipment that is required for you to achieve all these factors. So moving on, I have another question. Time is money. As knowledge is power is the first part of it, and there is a second half to this success equation. What is knowledge without execution? It is just a missed opportunity, right? So there is another saying that I truly believe in, as well as at K-Fintech, we believe that time is money. So we are in an era where everything happens quick. We have deliveries, any kind of grocery deliveries happening within 10 minutes, and we have cabs coming in within 5 minutes. So even your modern investors, they don't just want your wisdom, they want your speed, they want your precision, right? So if we cannot deliver convenience, the modern investor will simply find someone who will, right? So this brings me to Iris. So if Ignite is the brain of your business, then Iris is the high-speed engine that is going to accelerate that business. So as part of Iris, it has been only 9 months that Iris has been launched, and we already have approximately 63,000 plus users empaneled on this platform. And we are managing approximately 8 lakh crore AUM. That is a staggering amount for an app that has been only 9 months old. So Iris is a K-Fintech's unified execution desk. So let me explain a little bit in detail. It is a movement to democratize the entire distributor fraternity. So as part of Iris, we have, it is a one platform, every asset. You can execute mutual funds, NPS, AIFs, PMS, and fixed deposits from a single dashboard. So historically, we understand that industry has been very much siloed. You had different logins for mutual funds, different UIs for NPS, and even manual processes for fixed deposits for a conservative user, right? So Iris acts as a horizontal layer where all these actions can be done through one single dashboard. Whether it is an AIF for a HNI client or a digital FT for a conservative saver, the experience is going to be seamless. So every one of your investors, no matter what their AUM or the portfolio holding is, they're all going to get equal distribution of your services. And then we also added, we took feedback from you, we have added one more pain point, we have addressed it, where it is a single GST invoice downloads for all your earnings. The ability to send one scheme link to all selected multiple investors. Also Aadhaar-based mandates for instant and paperless onboarding. In one of the panels earlier, people were discussing about how onboarding is really important and it is going to help the clients, invest in quicker. So we are helping you achieve all those goals through Iris. Also, I also understand that there are multiple types of distributors here. You might be a huge company of an investor, or you could be a very small individual investor. We understand that the business is very complex. IRIS is uniquely engineered to handle these deep organizational hierarchies from level 1 down to the smallest branch. A standout feature that we take pride in is the service manager role. So we understand that, bringing in the client is a sales job, but what actually makes your client sticky is the service that you provide afterwards. So making sure that your support staff have the specialized tools to ensure that institutional precision is there in every client interaction. All right, now comes the most exciting part. So I've told you about all the services, all the features that we have as part of Ignite and as part of IRIS. The best part of this is it is completely free of cost. So we are here trying to contribute or actually give back to the society of the distributor fraternity. We call this Profit Ka Promise. The Profit Ka Promise funda is very simple. We are trying to help the distributor community time bachane ke liye, service fast karo, AUM or income badao. So as we move towards Viksit Bharat 2047, IRIS and Ignite, they are going to serve as the digital infrastructure for the next generation of Indian wealth. So much like how UPI has transformed the way payments are made, we are hoping to see that democratization of technology and professionalizing the intermediaries is going to bring in that kind of revolution in the Indian economy and would reach every Indian household. So how do you participate, or how do you reap the benefits of Ignite, and how do you use IRIS? The answer is very simple. You can write into ignite@kfintech.com if you're not empaneled with us, or if you do not already get the emails from Ignite. You can follow us on all our social media channels, which is @WeKFintech. We have our YouTube channel wherein we have the recorded sessions of all the NISM 13 series that we spoke about. And you can also participate in the weekly quizzes that we are doing, and you can always reach out to us. If all this is too much, you can simply walk into any of your local branch of KFintech, and you have a digital champion there who is going to help you across any sort of queries that you have. So at this point, I would like to congratulate the winners who are going to receive awards towards the end of this event. My sincere thank you. On behalf of KFintech, my sincere gratitude and thank you for all the distributors who have been contributing a lot to this society and the Indian financial ecosystem. You've been a great audience. Thank you, everyone.
Thank you, Hanisha, for that brilliant presentation. From stock selection and construction, we now turn to one of the most debated themes in the market today, small caps. Now, small caps have rewarded investors in cycles, but they have also tested conviction through sharp corrections. So where do we really stand now? Is this a phase of opportunity driven by earnings visibility and structural growth? Or does valuation and liquidity risk call for greater caution? Now, to lead this important discussion, I request on stage to join me Ihab Dalwai, Senior Fund Manager, ICICI Prudential Mutual Fund, Chandra Prakash Padiyar, Senior Fund Manager, Tata Mutual Fund, and Chinu Gupta, Senior VP, Fund Management Equities at HSBC Mutual Fund. Well, first of all, welcome to all of you here, ladies and gentlemen. Thanks a lot. Great to be conversing with you guys on such an interesting topic, right? Small caps. I mean, there's so much interest around this space, given the fact that this space has seen both euphoria and pain. So my question really is that, as I mentioned, this space has seen it all. Here on, how should one really tread? Do you think much of the outperformance that we saw between 2020 to 2024, is out of the way, is the best over, or would you say that it's just a cycle, we are seeing some pain, but it would kind of stabilize going forward? Chandrasekhar, you please go on and answer this question first.
Yeah, Chandra Prakash. So thank you for the question, and I'm glad to be at this session. I would say 2021 to 2024 was unusual in the sense that everything went up. Because our base effect of earnings was so low that every corporate in the small cap segment did extremely well. We are no more at the low base effect for most corporates, and valuations became astronomically high in 2024. Having said this, so I've been, or let's say in the last couple of years, we've been on the conservative side. We in fact stopped taking lump sum flows in Tata Small Cap Fund since June 2023. Sitting today, it looks to us at least that there are businesses available after this small correction that we have seen, which are likely to grow earnings at a very, very fast pace. And where valuations have become reasonable. It's still not cheap, but it's reasonable. Which means that if you are company, or let me put it this way, that last 4 years stock selection was not required. The next 3-4 years bottom-up stock picking is required. In other words, I am saying probably time has come for active managers to do better than passive funds. So good time for us.
Okay, good time for you. Ihad, let me come to you on this. Would you agree that there would be stories in the small cap space that would grow at a faster rate? Given the fact that, if you look at the last earnings season, the third quarter earnings season, you would see that large caps have been far more resilient than small caps, right? And when it comes to small cap, there has been pressure in terms of both top line and margins. So would you agree with Chandra Prakash here that you could find stories and perhaps at a much more reasonable valuation as well after the correction that has happened?
Correct. So I agree with the earlier speakers. We were also saying that valuations to some extent have corrected. There is no euphoria in the segment, small cap segment, which was there in 24, I think. But still, from a capitalization perspective across large, mid and small caps continue to trade at a premium valuation to large cap. And when you look at a very long-term history, like if you take 10, 15 years back, there were times when small caps used to trade at a discount to large cap valuation. I think that notion is, not there nowadays. But from a valuation perspective, there isn't much comfort. But from a bottom-up idea perspective, obviously there will always be opportunities in the small cap space. So I still feel, because there are certain sectors in the market where the leader itself is a small cap. Quite a few sectors are there, like in quite a few in auto ancillaries is there. Real estate, obviously there are a few large and mid cap names, but a lot of them are in small cap. Manufacturing to a large extent is represented in the small cap space, which is an emerging segment. So from a bottom-up perspective, there are opportunities. So I still feel it can be a part of a portfolio, small cap, a small part of a portfolio, but it can't be core of your portfolio.
It can't be core. Chinu, let me come to you on that note. As both the gentlemen have mentioned, that small caps have seen it all. You've seen 70% drawdowns. You've seen a 200% rally on certain stories as well. So clearly, it's not a broad story anymore. It's more about bottoms-up approach or stock picking, so to say. So are we at an inflection point, and what are the pointers one should keep in mind while doing that stock selection now?
I hope I'm audible now. Yeah. So I think in small cap, the key thing to watch out is stock selection, as you rightly mentioned. And I think the biggest mistake that one can do in small caps is to look at the earnings growth, because that is where the froth lies in small cap. The moment you start looking at earnings growth and investing, it's like you are bound to get caught. The key question that we should be asking in small cap is, can this company grow sustainably over a 3 to 5 year period? I think in small cap, that scalability is a far more important factor than sheer earnings growth. So, if one is able to separate, not look at 1 year earning growth, but look at the quality of earning growth. Look at the approach of the management. So we would want to back management who are able to put aside short term, but look at long term. Managements who have disciplined capital allocation. And even managements who can build management bandwidth apart from themselves, because most of small caps have promoters. But if you're able to trust someone else apart from yourself and have that bandwidth, I think these factors give us an indication that this small cap company can really scale up in next 5 years and become a mid cap company. So the entire mindset of finding a good small cap is with that horizon that you are looking for the next mid cap company.
Okay, so Chandraprakash, what is the ideal time horizon one should look at while looking at small caps? I just want to, for the benefit of the investor community present here, I just want you to answer it in Hindi. People usually go by the thesis, risk hai to ishq hai. So how much, कितना risk ले सकते हैं इस market scenario में?
समय की बात है. Like I said, किसी ने 2022 में पैसा डाला हो तो 2023 में डबल हो गया.
अब वो टाइम नहीं रहा.
नहीं, but I think selectively, which is what I was saying, selectively there are enough and more opportunities, at least that's what we can see. So from being very conservative last 2 years, I am at least personally speaking, or let's say from our side on small cap, Tata Mutual Fund side, we are once again very optimistic on small caps. So वक्त की बात है. हमको लगता है there are enough and more opportunities in the market today.
Right.
Finally, after, and this is my 25th year in being in the markets, meeting companies, and हमको दिखता है कुछ companies ने अपने R&D में कुछ किया हो, engineering companies at that. We are very surprised these days when we meet companies जिन्होंने engineering में कुछ ऐसा किया हो जो दुनिया में नहीं हुआ हो. So things are changing, and these are all small caps. So scalability can be quite interesting, like Chinu was mentioning, scalability. I think these are interesting times. So to answer your question, मुझे लगता है that वो समय वापस आया है.
Okay.
Where if you choose your stock well, the next 2-3 years can be interesting.
So tactically speaking, coming to you, you said that the proportion of small caps in your portfolio could be a little lesser, right? Tactically speaking, given the recent US trade deal and given earnings picture, any pockets that you would give preference to for the next 1 to 2 years?
Yeah, so I think from within the small cap space.
Yeah.
So I still feel like the earlier speaker also spoke, is that more bottom up stock picking and filters are similar, like in terms of high quality. Because in small cap, it is very important to understand that balance sheet strength has to be pretty good. And in terms of management bandwidth. So all these bottom up filters is something which from a stock perspective I would apply. But if you talk about sectorally, I still feel the entire manufacturing space is an interesting space within the small cap. It can be contract manufacturing, either in the pharma side, or it can be certain auto components or other manufacturing within the aerospace part, which are the emerging sectors, I would say, within the small cap space. So that looks interesting because, see, if you are coming to small cap investing, right, it is always good to find sectors or segments which you may not get in large and mid cap, right? Because I still feel if I'm ending up buying a small cap bank, is it as efficient or how can it challenge the large cap bank? What is the differentiated offering that small cap bank has? So where you have dominant and strong large cap and mid cap players, right? There, I think obviously you can have a tactical call in those segments, like it can be very cheap and you can play the normalization play out there. But if you want to find long-term winners, it has to be in an emerging sector or segment.
Where the company is a leader.
Yeah, and where you have small cap representation quite there. Like, so those are the segments which I would target.
Ihab, I have another question for you in terms of how small caps have fared versus large caps. Historically speaking, prior to the pandemic, prior to 2020, there is no concrete evidence that, small caps have really outperformed large caps. Of course, post-pandemic, we saw between 2020 to 2024 a 200% return on the Nifty small cap index itself. Do you think that era would ever return? Do you think that was just driven by liquidity and cyclicality? Or would you say that, that was a structural, kind of an outperformance? Do you see that era ever returning?
So, see, small cap investing or the success of small cap, I think at an index level, I feel may not be a correct way to measure, because a small cap which does well goes out of the small cap index, then enters the mid cap index. So if it keeps doing well, that return is not completely captured in the small cap index. But having said that, the success ratio is low in small cap. So if if I think 10 stocks will do well, maybe 3 to 4 would end up doing well. But the success ratio in mid and small cap, in large and mid cap, is relatively higher. So I still feel at an index level, small cap to do well, I still don't feel that today is the correct opportunity. It is still bottom up, emerging segments of the market is one should identify. That is the approach, is what I feel. And similar to the earlier speaker also, that active small cap is something which should really do well, because there are opportunities from a bottom up approach. Index, I'm not pretty sure, because at an index level, can small cap do well? Because at an index level, when I look at it, right, valuation is still at a premium to large caps. Earnings momentum is coming off. Obviously, mid and small cap did grow faster. Earnings did grow faster than large cap, and that's one of the reasons why they had delivered better returns than large cap. But I think that momentum is coming off. And one interesting point I just wanted to put is that even today, the interest in small cap category is not less.
It's not, yeah.
So when you look at the mutual fund inflows into small cap category, it's there between 40 to 50,000 crores on an annual basis for last 2 years. So as long as that interest is there, you're not going to get them cheap. So I think an ideal scenario will be that obviously mutual fund flows should keep coming, but not coming in this category. So if you get very low flows into this category, then I think valuations will be lesser, opportunities will be more, is what I feel.
But do you see that happening anytime soon? Or do you think it will be elevated?
So flows, but I think ultimately it'll test the investor's patience, right? If someone who's come for the last one and a half years has not made much money in this category. So logically, I think, because generally flows chase returns, so in that case, I think it should come off, I feel, but it's not happened yet.
Yeah. So of course the returns have not been there last few years, as you mentioned, Chandra Prakash. So so many stocks have seen a correction of 70 to 80% from highs, right? And that's perhaps why at a time when the index was hitting record highs, the mood was pretty somber in the market, because portfolios weren't really performing. But despite the kind of correction some of these stocks have seen, they're still trading at elevated valuations of 25x or higher. Do you think that's justified?
So what you're referring to is small cap index from a valuation perspective. Which is why I was saying initially also is that I think if you pick and choose companies today in this small cap segment, and I am referring to the market cap band of between 5,000 crore and 15,000 crore market cap band, not necessarily between 15 and 34, because that's also small cap.
Yeah.
But between 5 and 15,000 crore market cap today, there are more like 400 companies to choose from. And within that 400 companies universe, there are enough companies which are available at closer to 10 to 15 PE. With cash flow generation, growth in earnings at 20% plus expected over at least that's what we believe, and return on capital employed closer to 20%. Now I think quite an amazing environment to be in. So you have to pick and choose. All I'm trying to say.
Where do you find these stories? I mean, if you could just give us some examples as well. A lot has been spoken about data centers, the likes of NetWeb, etc. And of course, Ihab also mentioned a few pockets. And of course, he also mentioned the fact that companies which are leaders in their own rights within the small cap space when it comes to the business. So any such hidden gems that you have really spotted and that you could share on this stage?
Lighter note, all of you have to invest in my fund to find out. But yeah, so like you have mentioned, we are seeing some precision engineering, or one, auto ancillary side, two, engineering side, cap goods, manufacturing. So I'm not referring to infra. I am referring to more manufacturing part of the ecosystem which supports the whole infra setup, which you mentioned, data center, for example. Though maybe you mentioned a different name, we like something else.
Sure.
But I think you have to pick and choose businesses today. The good thing is that, and which is what I was referring earlier in a remark, is that if you notice in this economic survey this year, the economic survey document has one full page on how patents in India have been skyrocketing over the last 3-4 years. And we see this example across companies, many companies today in India, which have done quite hard work or efforts over the last 5-6 years on R&D. And finally, they are achieving patents and commercializing over the next 12 to 24 months. Starting with India, but then the whole world is their market. So we are quite excited these days, actually. So I would point your attention towards manufacturing, and that too towards engineering, capital goods. Manufacturing is where we see scalability quite significant.
Sure. Chinu, anything that you would like to point out in terms of where are the pockets of opportunity after the kind of drawdowns we have seen in some stocks, and is it the right time to look at those opportunities?
So let me answer the time part first, and then I'll speak on opportunities. So time-wise, what I feel is after September 24 peak, where we are sitting today, we are still not there. It's 15% down, 18 months of time. So you have a combination of some price correction and some time correction, and then you're here debating whether it's still the right time or not. 1.5 years back, everybody felt it's the right time. So I think that's the difference. You want sentiments where people are questioning. Things are happening. Trade deals got signed, EU and US. Market has just not shown any kind of reaction. So that is the kind of, you can say bearish sentiment which is there in the market, which is excellent for picking good stocks. So best time for investing, right time or not, it depends on the patience of the investor. Small cap category requires patience. You need a patience of 2-3 years to be there in the stock at the time, wait for it to nurture and then grow. I think that's about the timing for small cap. Opportunity wise, I would want to, kind of agree with both of them and say that manufacturing is a beautiful space which is coming up. In addition, especially in the light of EU and US deal, I think we are coming back to that story of India becoming part of global supply chain. Somewhere in 2025, this story got lost. When we stood with China, same side, 50% plus tariff, we were questioning what's happening. I think now we are going back to where the story was. And companies who wanted clarity on tariffs, they were waiting for shifting the supply chains to India, can start doing that now with both these deals behind. So manufacturing is an excellent space. In addition, with US investing in AI-related infra, investing in power infrastructure, Europe waking up to the realities of geopolitical situation and investing in defense. Any of our Indian companies who can become part of supply chain in either of these pockets, so export-oriented companies who can become part of these supply chains, I think they will be interesting. And just last, not the least, on domestic side, I think today technology is giving an excellent edge to small cap companies. Earlier, the barrier between a large cap company and small cap company was wide. Call it distribution barrier, they couldn't cross. Today in Indian market, that barrier is no longer there. You have several channels. Small cap companies can scale up. The way I think he mentioned about banks and NBFCs, I agree. Earlier, we wouldn't look at a small cap bank and NBFC. But today with technology, you have these tools available. So with good underwriting practices and excellent use of technology, even these small cap companies in these sectors, where hitherto they were not acceptable, I think they can call for a good investing opportunity.
All right,
if I can add one example, if you have time.
Go ahead.
I was listening to a recording of Mr. Mukesh Ambani, CNBC event just happened very recently, and where moderator Ms. Shireen Bahan asked a question. I don't remember the exact sentence, But the gist of it I want to say here is that Mr. Mukesh Ambani said that, so she asked on how he thinks about India. And his response was that in the last few months, not exact words, in the last few months, all global CEOs want to come and meet me to do business with me. I don't have enough time to meet all of them. So sometimes I have to reject, or I can't meet all of them. We see this across the segment. We are seeing most global multinational companies want to do business in India, and manufacturing and small cap is all about manufacturing, as Sebi put it. There are so many opportunities, as Chinu put it, supply chain addition for India. It's coming now and now. I mean, which is why we are very excited, actually.
Sure. I think on that note, we are running out of time. We'd like to thank you, ladies and gentlemen, for joining in this evening. Thank you. It was a lovely conversation. I wanted to extend it further, but, sadly running out of time. Thanks a lot.
Thank you.
Well, thank you everyone for a balanced and insightful discussion on navigating the opportunities and risks in the small cap space. As we look beyond individual segments like small caps, a larger question emerges. India's growth story is often viewed through the lens of headline indices, but real opportunity does not always sit within the Nifty alone. It lies across sectors, themes, and businesses that reflect the depth and diversity of India's economic expansion. What does investing in India mean beyond benchmark exposure? What are the structural growth drivers, and how can investors capture this broader opportunity? To lead this conversation, I would like to call Anisha Kumar back on stage, and joining her is an investor known for his conviction-led approach and focus on long-term wealth creation. Please put your hands together for Ajay Khandelwal, Fund Manager at Motilal Oswal AMC.
Thank you, sir, for joining us today. That was a great conversation we just had about small caps. And so the market is a very interesting place. There are a lot of new opportunities that are coming out. But, before that, maybe I want to kind of just get your perspective on, how are you looking at, what are your expectations with regards to earnings growth going ahead in FY27? Do you think the prices could be better?
So, I'll start with earning expectation. But just to give a context, we talk about earning growth, valuations. But in business, what matters is that how the balance sheets. Because for us, a one-year growth may be right shifted to, say, next year. A quarter growth may come into next quarter. But fundamental difference that is happening in India now is that compared to last, say, 10 years back. You look at NSE 500 companies, small cap, mid cap, the leverage has gone down drastically. The last cycle, I would say, the leverage has come down to half. Now, see, the last cycle growth came from maybe PSU investments. We still complain about that private companies are not investing. But they have balance sheets to invest. So this year maybe growth, for example, 25, the earning cut happened. 26, we are still now, given the last quarter numbers, I have not seen any earning cut from any of the brokerages. 27, people, every time we start with a bullish assumption that we'll grow at 15%, then during the year we realize, okay, it is maybe 12. So I think this year, again, we are starting with, say, 12% kind of earning expectation. But the base is right. All the factors which lead to earning, for example, financial deleveraging, margin continuity, because a lot of these commodities have seen changes, which has hurt margin. All these things are there in the base numbers. So I think we'll start with an expectation of 12%. Mid and small obviously will have a higher growth compared to large caps.
But you were just talking about Capex. So are you expecting that Capex growth to come in the next financial year?
So see, when we talk about Capex, the good part is during last cycle when private Capex happened, a lot of these industries put together, the capacity expansion happened at the same time. And when economic cycle turned, the NP addition was enormous. This time what is happening is that the public investment has actually so far happened. But if we track the numbers, so for example, companies doing say 100 million Capex every year, the number is increased from 135 to 165. Gradually it is improving, and there's one more difference that is happening. Last cycle, the cement, power, road, large capital intensive businesses saw the Capex. Now when we see the businesses, they are more capital light in nature. So generally the capital intensity has changed. Now we talk about OSAT plants, maybe data centers, which are capital guzzlers. But generally businesses have become more scalable, and the capital intensity is coming down. That is another reason why multiples structurally have gone up, because these businesses require lesser capital.
Now, as a fund manager, how do you approach balancing risk and opportunities, especially when we're looking at stocks beyond Nifty 50?
So, see, the guiding principle is again earning growth. Now, I'll give you again some context why Nifty 50 and growth is happening beyond it. So, 10-15 years back, Nifty 50 companies used to contribute almost 65% of the profit pool, which has now come down to 55%. So, the Nifty 50 beyond companies are contributing more. And if you look at the construct also, you have lenders, IT companies, maybe large auto companies. These are the ones which are there in Nifty 50. Whereas beyond Nifty 50, you have non-lenders, you have consumer companies, you have industrial manufacturing companies. And I think in the previous session also people spoke about where the more of the earning growth is coming, which sectors are representing this faster earning growth, which are clearly the representation is much higher beyond Nifty.
Mid caps, small caps, what's your preference over there?
See, when you consider mid-cap, obviously they've reached a scale. And in an environment where there's volatility, size of business matters. But at the same time, look at the large caps. For example, IT. Now there is disruption and stocks have fallen like small caps. And during result season, even mid and small caps we have seen when they deliver strong earnings with good fundamental cash flows, even a 50p stock goes up 20% on results. So please understand the volatility part is there across segments. There are enough and more examples in large cap also where volatility, disappointment in earning leads to sharp stock fall, which is not a case which is associated with only small caps. So my preference is, I would say, the businesses where they have enough capital to fund their growth, which are present both in mid and small cap as well.
So what is your biggest contrarian bet that you've taken? Biggest contrarian bet that you've taken? Or, I mean,
recently if you look at the whole Moti has become contrarian only to the market. So I think some of our schemes, we are still bullish on certain sectors which are, in recent time they've faced headwinds. For example, IT, we held on to our conviction. In couple of days, for example, one of the large Indian IT company now speaking about how they're going to tie up with all these new AI companies. So things are changing so fast. And when we've spoke to a lot of these companies that are there in our portfolio, they said clients 5 to 10% of their budget or 5 to 10% of their clients are looking at adopting AI, but it is still very early stage. You remember large banks used to talk about in India where they say, let it stabilize. We'll see how these technology changes are happening. We have large customer base and we'll adopt it. So for us, some of the contrarian bets that way is software is one of them. And then we have manufacturing, but I think manufacturing is something which is now well regarded.
So one last question. What do you think when it comes to investor, what are the biggest blind spots that are there in the market for investors right now?
Blind spots, I think if I have to summarize current macro, even though we are so much bothered about near-term performance, but if I have to look at the health of balance sheet, in terms of macro, the stability, we have never seen this kind of inflation. We have never seen this kind of current account deficit. The state deficits are coming down. Everything is now by the book. Currency so far, I think in last 3-6 months, we have seen depreciation, but otherwise last 3 years we have been holding up well. So I would say that we are too myopic about this last 1.5 year returns, but the macro and micro has changed drastically. Business have become far more efficient. So we need to look beyond returns. We need to look at these hard numbers, and which will give a lot of confidence to investors.
Thank you so much, sir. Appreciate you taking your time for
Pleasure.
this. Thank you.
Thank you.
Thank you, Mr. Khandelwal and Anisha, for those valuable insights into India's growth story behind the benchmarks. And now, we move on to a special segment of the evening, the Mutual Fund Summit Felicitation. The mutual fund industry's growth story has been built on performance, innovation, discipline, and investor trust. Our award segment celebrates institutions and leaders who have demonstrated consistency, resilience, and impact in shaping India's investment landscape. To present the felicitations, may I invite Navneet Munot, MD and CEO, HDFC AMC, to kindly join us back on stage. And now let us begin the felicitation ceremony. Our first category is Growth Leader North for highest net sales. We are proud to felicitate NJ India Invest Private Limited as the growth leader for achieving the highest net sales in the North Zone. This recognition celebrates NJ India Invest's exceptional distribution strength, deep investor reach, and consistent momentum in mobilizing assets and expanding mutual fund participation. Well, congratulations to the winners. Our next category is Investor Base Excellence. We are pleased to felicitate Jhaveri Securities Limited under the category Investor Base Excellence. This recognition honors their remarkable ability to build and nurture a strong, diversified investor base through disciplined advisory practices, sustained engagement, and long-term relationships anchored in trust and performance. Well, congratulations to the winner here as well. Next category is SIP Champion North Zone. We are delighted to felicitate NJ India Invest again as the SIP Champion North Zone. Now, this recognition celebrates their leadership in driving systematic investment participation and strengthening long-term wealth creation habits across the region while deepening retail engagement. Well, congratulations once again to India Invest. Moving on to our next category, FinTech Partner of the Year, highest AUM addition. We are proud to felicitate Ind Money as the FinTech Partner of the Year. Highest AUM addition. This recognition celebrates their technology-first approach and exceptional contribution to expanding assets under management through seamless user experience and data-driven advisory capabilities, enabling smarter and more transparent financial decisions. Well, congratulations there. The next category is Women in Distribution Nari Shakti, Total AUM. We are honored to felicitate Rashmi Thukral under the category Women in Distribution Nari Shakti. This recognition honors her outstanding leadership and remarkable contribution to the financial distribution ecosystem, reflected in the strong AUM built through strategic vision and client-centric advisory. She has driven scale while inspiring greater participation of women in wealth management. All right, moving on, last but not the least is our Young Achiever Zone-wise, age 35 and below category. We are pleased to felicitate Tarini Sharma under the category Young Achiever Zone-wise, age 35 and below. Now, this recognition celebrates her dynamic leadership and impressive growth at a young age, marked by strong client engagement, disciplined portfolio building, and a deep commitment to long-term wealth creation. Well, thank you, Mr. Manoj, on that note, for doing the honors, and congratulations to all our award winners as well. Your commitment to performance, innovation, governance, and investor trust sets important benchmarks for the industry. Well deserved, and many congratulations once again. Well, as the financial distribution ecosystem rapidly evolves, the need for a unified, future-ready platform has never been greater. That's exactly what Moneycontrol FIDEX 2026 sets out to achieve by bringing together India's diverse financial product manufacturers and the vast network of distributors, advisors, and wealth partners onto one powerful industry stage. Here is a glimpse of what's in store for you at Moneycontrol FIDEX 2026. Well, what a truly powerful and thought-provoking day of conversations, from portfolio construction and market cycles to global access and emerging opportunities. Today's discussions reflected the depth and responsibility shaping India's mutual fund ecosystem. Now, on behalf of Moneycontrol, I sincerely thank all our distinguished speakers for sharing their time, expertise, and perspectives. A heartfelt thank you to our partners, HDFC Mutual Fund, Axis Mutual Fund, KFin Technologies, Reliance Industries Limited, Motilal Oswal Mutual Fund, Mirai Asset Mutual Fund, and ITI Mutual Fund for their continued support and collaboration. And most importantly, thank you to all of you in the audience for being part of this meaningful exchange. We look forward to continuing this dialogue as India's investing journey evolves. Thank you and have a wonderful evening.